Tell you all about it.
Y'all got kicked down. You kicked down a seat. Quite all right. Just give it to Dale. Oh, no, it's not on.
I can.
Oh, okay. Yeah, that's. a little bit
But it's
better.
not, it's not. It's
We
not-
don't have. Yeah. Yep.
but
We're
these
not live,
messages-
right?
Okay, I just heard some. I
From
heard
the
Anya
laptop?
coming from here.
Nothing.
Good morning, everybody. I'd like to welcome everyone to welcome everybody to the Lorraine County Employees Retirement Association Retirement Board Strategic Workshop. I'd like the administrator to take the roll, please.
Trustee Cooper? Here. Trustee Helwig?
Yeah.
Trustee Martinovich is absent. Trustee Poole is not here. Trustee Robbie?
Here?
Trustee Silverstein?
Here.
Trustee Vasquez?
Here.
Trustee Vila?
Here.
Trustee Werby is not here. Trustee Healy?
Here.
Trustee Jones is not here. Trustee Shaw? Mr. Chair, all members of the board are present except for trustees Martinovich, Poole, Werby, and Jones.
And do we have anybody attending remotely today?
We have no requests for remote attendance.
Do we have any comments from the public? Okay. So today we've got a full agenda, very exciting agenda. Hopefully everyone's had a chance to take a look at it. The first item on the agenda is policy considerations when the plan reaches fully funded status. Graham and Bill are here from Chiron. So Graham, thank you again for coming, and we'll let you kick us off.
So maybe just a quick introduction. This is purely just a policy discussion, but it is sort of well timed in that, as you'll recall, as our most recent actuarial evaluation, June 30th of 2025, your funding level for the total plan was 96.2%. You did have some of the employer groups, particularly the county special district group, that was higher than that. It was at 98.4. So you're approaching 100%. Your investment returns, at least through the most recent flash report that you've seen, which was February, was over 11% for the year. So at least so far, you're in returns for, or you're on schedule for returns over your assumption. So this seems like a good time for you to start thinking about policy things. So this is not an action item. It's a or thought item. And if we get there, then there may be further steps to go. So with that, I'll turn it over to Graham.
Thank you very much, Jeff. Good to see you all. So as Jeff said, this is a big picture kind of presentation. We're going to talk about a new concept. It's actually similar to something we discussed at a strategic workshop several years ago. But I'm just going to lead off with a brief introduction. We're going to talk about sort of where we are in terms of, how what's been the focus of the plan for the last decade and a half. And then where are you as of 2025 valuation, the most recent one we've completed. Then we're going to start to talk about what are the different trade-offs when you've got different decisions about risk and reward as you get to 100% funded, right? As you get to fully funded status. They are different than when you're in the 60% funded range. And then Bill will introduce this new sort of concept about using your surplus, potential future surpluses, to reduce risk using what we call a split valuation approach. And then we'll answer any questions. So just as the introduction, the focus for the last 15 years or more for both your plan and most public pension plans has really been on recovering your funded status from the Great Recession, right? So your funded status, MCER's funded status, if you looked at what did you have in terms of the market value of assets in 2007, your status was 96%, right? Nearly fully funded. It dropped all the way down to 61% in the 2009 actuarial valuation, right? Huge losses in your investment portfolio, causing your funded ratio to fall by 35% over that period of time. Oh, sorry.
I can just jump in. This is a workshop, so if anybody has any questions along the way, I think Mr. Graham would welcome them throughout the presentation. So don't hesitate to raise your hand if you'd like to ask a question.
Yes, thank you very much. All right. Now we're seeing it. Yeah. Okay, thanks. So what took place in response to the changes in funded status, right? What were some of the events and the actions that have been taken? Well, first you had PEPRA, right? That happened at the state level, which limited benefit formulas that could be used for, future new hires after 2013. You've also transitioned towards using significantly more conservative assumptions, and that's true for both MSERA and other public pension plans in California. Your discount rate has been reduced from 8% down to 6.75% gradually over that time. The actuaries have implemented what are known as generational mortality assumptions, a more conservative way of looking at mortality, where we are baking in projections that mortality is going to improve in the future, right? You're going to have lower rates of death over time. And actually, Marin, you were ahead of the game in adopting this. You adopted those assumptions back in 2014. So you've had more time to build up your funding as a result of those more conservative mortality assumptions. A lot of other plans didn't get to those until like the late teens. And then contributions have gone up, right? Contributions back in fiscal year ending 2010, around 16% for the county, 39% for Novato and San Rafael. They hit a peak, and those peaks differed in when they came through. They were in the sort of mid to early teens, 5 years after the Great Recession, right? Once those investment losses had been fully phased in. But the county's rate peaked around 28%, Novato at 51%, and San Rafael at 62%. We've seen our rates come down quite a bit since then, right? Both because you've been paying down the unfunded liability, the payroll has grown, and then the impact of PEPRA, right? So members are receiving lower benefits and they're also paying a higher percentage of their contributions. So the county's contribution is actually getting pretty close to where it was at the beginning of the period, down to 18.5%. Novato's is actually slightly less already at 37%. They have a bigger impact from PEPRA because they are pretty much almost all public safety members. And PEPRA had a bigger difference on public safety. And then San Rafael's is at 44% or 49%. So here's a picture of the funded ratio. Those are the bars, is showing you the funded ratio since 2007. And it has recovered to that same level, but we have the same funded ratio under a much more conservative set of assumptions. So that line that's going down, that's the discount rate, right? So you can see where it was 8% and it has fallen to 6.75%. So even though your ratio of your assets to your liabilities is the same as it was back in 2017, if you had measured their liabilities back in 2008 using these more conservative assumptions, you'd have a lower funded ratio than what you've had now. So you've had improvement in your funded position, both because of the recovery in your assets, right, from good returns as well as contributions. But you also have a more conservative set of assumptions underlying our estimates of the liability. So that puts you on a more firm financial position. We are expecting, and we'll see this in a minute, when we look at the contributions, significant reductions in those rates out in 2032. And the reason for it being in 2032 is that's the end of the amortization period for your biggest chunk of the unfunded liability. So your unfunded liability is split up into various layers based on when they occurred. And that first layer is due to expire in 2032. It will be fully paid off. Other things have happened since then, some which have increased the unfunded liability, some which have decreased the unfunded liability. But the biggest chunk, and you'll see this when we look at the projections, in 2032, you do see a pretty big drop in the contributions, especially for San Rafael and Novato. Okay. Your plans are expected to hit 100% funding before then, because you've had some pretty good gains the last few years, right? And we'll look at that in terms of our projections also. So,
You had a question?
Is the discount rate accounting for inflation?
yeah, so the 6.75
Mhm.
includes inflation.
Okay.
Right. So you have a 2.5% assumption, and then we assume that you are going to earn 4.25% above that in terms of your real rate of return.
That's 6.75 in 2020.
That's when you dropped.
That's when we dropped. So just
Yep.
right before inflation really started taking off.
Yep.
Lucky
And
fall.
it's still long-term assumptions are still pretty close. Your 2.5% assumption
Mhm.
is pretty close to
Yep.
what you see in terms of long-term outlooks.
Yeah.
Right.
Thank you.
So all of this being said, the focus has been get on recovery in the funded status, right? Getting more conservative assumptions, more which make it more aligned with what your investment consultants think you're actually going to earn on those investments, which you have been able to beat those benchmarks over the last 10 years, as well as, going to more conservative assumptions, increase the contributions, and then your funding policies also were designed to improve the funding level. So you've accomplished that task. The focus going forward is likely to shift towards preserving that funded status, right? Now you've got there. How do you stay there, right? And the strategies that you use may be somewhat different from the funding policies that you used to get back to fully funded. So let's jump right, a really quick review of where we are right now, the 2025 valuation. So the chart on the left is showing year over year changes in your funded ratios. So as Jeff said, for the plan as a whole, it went from 92% to just over 96% last year. All of these funded ratios are calculated on what we call the market value of assets. So what did you actually report in your financial statements that you had in the bank as of June 30th, 2025? You'll hear some plans use what's known as the smooth value of assets or the actuarial value of assets. We're not using, MSAR doesn't use that. We look at what did you actually have, and that's what we're computing your funded status on. So the county group, as Jeff said, we're over 98% as of the last valuation. San Rafael just under 89%, and Novato at 93%. We've talked in prior meetings about some of the issues that cause those funded ratios to diverge in the different groups. And then on the right-hand side, we're showing the contribution rates. So those contribution rates are made up of three pieces. You've got that dark blue bar, that's the normal cost, right? So that's the employer's share of the benefits that are being earned by members for this year's service, net of the member rates, right? So that bottom bar is what's sort of the ongoing cost of the plan, the benefits that members are currently earning. That small bar in the middle is your administrative expenses that are covered by both the members and the employers. And then the bar on top, gold bar, is the unfunded liability rate, right? The payment that's being made to amortize that unfunded liability over time. Let's focus on that right now. You see that this is the cost that essentially is expected to go away once the plan reaches full funding and all of those amortization bases fall off, right? We do expect that those normal costs will change over time as you further transition towards the PEPR membership, but they're not going to change dramatically. These are dramatic shifts in the expected contributions if you stay at around 100% funded, particularly for San Rafael, right? They're making a payment of over 33% of pay to pay down that unfunded liability. All right, so now that's what's happened so far. Where are we expecting things to go? The left-hand side is showing the projection of assets and liabilities. So what's generating your funded status. The little red sliver on top, that's the unfunded liability. And what you see is for the plan as a whole out in 2030-ish, that red bar flips from being on top to underneath. What does that mean? Being on the bottom means it's actually a surplus where your assets are expected to exceed your liabilities, right? And as you can see, that red bar is pretty small as it, to begin with right now. If we look at the counties, that unfunded liability basically disappears after this current valuation if all of our assumptions are met. It happens a little further out for Novato and San Rafael, right? So you can see for San Rafael, it's around 2031 where you see that changeover. But for all the plans, all groups, that unfunded liability is a pretty small percentage and expected to sort of go away within the next 5 to 6 years, okay, as those unfunded liabilities are paid down. This is based on an assumption that you will earn exactly 6.75% each and every year, and all of our other assumptions are met, right? So this is not by any means a guarantee. This is just a projection if those things come to be true. On the right-hand side, we're looking at the projection of the contribution rates. And here, as I pointed out earlier, is where you see that big contribution sort of cliff when that that first layer of the unfunded liability falls off in 2032. Now, for the county, the plan is expected, their group is expected to be fully funded at that point. And under PEPRA, you cannot contribute, employers cannot contribute less than the normal cost of the plan until you become more than 120% funded and all these other, conditions are met, right? So that's why you see the county's contribution fall. So the county specifically fall and then stay flat, because what's happened at that point is the plan's expected to be overfunded. And actually, if you were to amortize that surplus, you would see the contributions go below the normal cost, but that's not allowed to happen under PEPRA. So that's why you see that very flat contribution rate for the county falling over time as the normal cost falls as you finally get through. So you've only got PEPRA members.
Graham, question. At some point in the presentation, will you talk about the sensitivity of that 6.75% assumption?
Yeah. And
Because if we went down to 6.25, I'm just curious, like how much would that change? Does that dramatically change everything? Or is it really not that?
so that's a great question. We don't have a sensitivity analysis on that within this presentation. Ballpark it around a 4% change in your liabilities for a quarter point change in your discount,
Okay.
right?
Okay.
Something like a 2 to 3% change in your overall contribution rates can be more for the safety members, less for general, right? Now, we're not making any comments about what we expect to bring back when we talk to you about the experience study, but those concepts of changes in the cost based on changes in the discount rate, that is going to be important as we get back to this split discount, the split valuation approach that Bill's going to talk about. Oh, I guess you're right. But it's not just the quarter point. It's
But also remember that that information is also contained within the valuation, where in the portion of the valuation it talks about the LD-ROM, where it shows what happens to the funding levels and rates if you move 1% this way, 1% that way, right? So there is information that shows this is how that would change.
just to close the loop here, just in terms of the projections of the contributions. So county does see a decline in their rate, 18% down to 12%. It's much more dramatic for Novato and specifically CenterFL, right? Because they have those much larger amortization payments to begin with. So Novato's is projected to go from 39% down to 23.5%. You can see another drop out here in 2039 to 2040. That's back when we, after 2008, we took a portion of the big change in the unfunded liability and we amortized that over a 30-year period. So that's the end of that 30-year period. It doesn't show up for the county because their contribution is already projected to be at that level of the normal cost, but you can see it here for Novato. And then if we look at San Rafael, dramatic change, right? 50% down to 18% of pay in a single year, right? That's a dramatic change in the contributions.
Graham, just a question, looking at the charts from before, the crisis was created when there was an 8% expected rate of return, if I remember correctly. And then we had a significant change in investment returns. And now, 12 years later, we're still kind of digging out of that crisis, if I understand. So
yeah,
it feels to me like we need to be very careful about the expected rate of return, not today, but just understand that being high can have huge impacts, particularly to these smaller organizations that are seeing a huge impact to their budgets because now they're putting in so much more when maybe had they done that earlier,
right.
it may not be quite as dramatic.
So the financing of these plans, it's going to be what it is, right? Because, or the requirements are going to be what they are because events will unfold as they unfold, right? The key is pay me now or pay me later, right? So if you're more conservative in your assumptions now, you have lower expected returns, it's going to increase what the contributions are that go into fund the system, right? If you have those higher expected returns and then they don't come to be true, you will have to increase your contributions later on, right? Now, those losses in 2008 were so large that it did take some time to come back from that. But again, if you look at where you are now and where you were prior to the Great Recession, if you use the same assumptions in both periods, you'd be better funded now than you were then, right? So in some ways, you've more than recovered. You've recovered and put yourself on firmer footing.
Also, I think, remember, and Graham can do the math for you here, is that you're assuming a certain amount, right? Every year. So if you get right on that, then you get these perfect charts the way Graham's showing you. But if you lose 20%, this is roughly the loss in 1 year, and you were expecting 8, what's it take for you to get back to par next year? Double plus 8. Right, just to get back to par. So that's not going to happen. So it's going to take you a while to do that. I think your point, though, is well made about the discount, is that the lower the discount, the less volatility there may be, depending on what happens with gains and losses. But your responsibility as the board is to set the discount rate at a level that's recommended by your actuary, because that's what they do in their experience study. And this discount rate has worked now for a number of years, but you've also brought it down. And what that means to your sponsors, though, too, is they see more aggressive funding requirements. They've got to put more money in now, which when they get compared to other systems that aren't putting as much money, the question is, well, why are they not as putting much money? Well, because the assumptions may be different. But I think you have, since the great financial crisis, had a more conservative approach to the funding, both in how you want to finance it, discount rate, and the contributions that you're expecting to come in. And I do think it's important, and Graham can talk about this, is that you have a very firm grasp on the different levers that you control, because you control the assumptions. You set the assumption. So you set the financing plan. Graham says this is how that worked based on how you set it.
And you made some decisions in terms of your funding policies, right? How do we pay off these different layers of the unfunded liability? And you've done things that make sure, a long time ago, plans would amortize things over 30 years regularly. Now you're using shorter periods to pay off losses. There is some discussion, and we might talk about this. A lot of plans, when they get to fully funded, well, it's sort of moot for you. You can't, the employers can't contribute less than the normal costs. But for plans that don't have that restriction, a lot of times they'll say, okay, if we have a surplus, we're going to amortize that over a longer period, like 30 years, right? To be a little bit more conservative. So they're not, they're not using up that surplus as quickly. But we'll get into that discussion in a minute.
Quick question, actually, I don't know, Jeff, if you were here at the time, or maybe Jim, I'm pretty sure you were here at the time. What was the response from our sponsors, if you will, when we did start bringing that down after 2008, 2009? Was there a lot of pushback? Did they agree? What was the general sentiment?
Well, I think let's go, first of all, I'll answer that, but go back to the GFC.
Sure.
And what happens to contribution rates in a year where you lose 19.9%.
Yeah.
So employers were faced with a more than double increase in contribution rates in a single year. So at that time, the feedback that this board got from your employers were, we're not sure we can absorb that all given the economic conditions. Is there a way for you to put that into your regular amortization period, but also put some of it into a special amortization period? That's how you ended up with what Graham described, that you've still got half of the 2008 loss that's over a longer period. So you discussed that. That was input you got from your employers, and you discussed that and said, I think we can do that. Certainly stretches it out over half of it out over a longer period of time. So the employers gave you input, and you factored that into your decisions about how you dealt with the funding for that year, 2009. I think after that, there was a realization that, economic conditions, and this is feedback and Jim can provide too, meant that you needed to consider reducing your discount. Graham already said this, it has a definitely different impact depending on the employer. Okay. So the county of Marin, which is a lower cost group because it's more general employees, 2% of pay by 0.25%. San Rafael, though, way bigger than that impact. So it's not, you can't just have a one size fits all implementation of it. You have to decide what's best for the plan and funding and long-term, and remembering that what you're trying to do is pay for the benefits that have been promised. And it's threading a very fine needle.
Well, one thing that another action that this board took that does make it, I'll say more palatable, easier for the employers to absorb assumption changes like that is you are using something known as direct rate smoothing. That when we're setting those amortization schedules, it's kind of like how some plans do asset smoothing, right? They don't recognize in a single year the current year's investment gains and losses and the contributions. They spread it over a 5-year period. They smooth them in and then phase them out. We do the same thing. We don't use the smooth value of assets. We do it directly on your liabilities when we set up those amortization layers. And we don't just do it for changes for investment gains and losses. We do it for everything. And for assumption changes, you phase in the impact of the assumption change on your unfunded liability over a 3-year period. Now, some systems that don't use this approach, they have done that in the past on an odd ad hoc basis. Like, oh, we made some big changes. We're going to smooth that in for the employers. They make a decision to do that. For you, it happens automatically so that the employers know, even if you have a significant change in your assumptions, that impact on their contribution rates, while it will ultimately affect, the amount that they have to pay, it is phased in over a 3-year period. So they don't have to absorb the impact on their budget in a single year. Does that help?
One thing to add, and this is not on the actuarial side, and I was not here for this, so Jim can talk about this, but one thing that you did do, or more importantly, didn't do, is you stuck to your policy about investing. You did not sell out. Some systems did, and they're still trying to recover for that. So you stuck to your policy, which meant in 10, 11, and 12, you got the bounce back. You got it immediate. And I think that ultimately sticking to that might have been the hardest decision that you faced at the time, but you did it. And that has ended up being as powerful as anything else you've done over here on the financing side.
All right. So I want to start to transition towards, the concept that Bill is going to introduce. But I'm just going to quickly talk about why is this important? What's changed in terms of your things that would affect your decision-making process? And it's really the risk and reward trade-off, right? So what we're showing here on the left-hand side is what would be the impact of a 5% gain or a 5% loss compared to your assumption if it were to happen in 2026 versus if it happens in the year 2031. So right now, this is for MCERA as a whole in both these exhibits. If you have a 5% gain, right? So you earn 5% more than your assumption. You earn 11.75%, right? Versus a 5% loss means you only earn 1.75. Doesn't mean you actually have a negative return, right? These bars are showing the impact on the employer contribution rate given those losses or gains, right? And you can see how it's, right? We know we phase in the contribution impact over a 5-year period. So you can see in a loss, those contributions increase. And at the end of a 5-year period, they've increased by almost 4% of pay. This is for MCERA as a whole. If you have gains, it brings those contribution rates down. But you see a touch of what's happening here in that last year. Actually, you don't see much of a decrease in your contributions in that last year. Why is that? Well, that's when the plan is expected to be fully funded. And once you get to that point, if you have a gain, it could result in a surplus, right? But the contributions can't fall below the normal cost because of PEPRA. So you're not getting any benefit from that gain in terms of the immediate impact on the employer rates. For the county, you can see that actually, happens a little sooner. Novato and San Rafael, because they don't have that as strong a funding position, and because they are more heavily weighted towards their safety workforces, they see a much wider range in those contribution rates. Let's step 5 years forward, though, when all of the the plan, if all of assumptions are met, and we have that 5% loss or gain in 2031, there's no upside. right? Look at the right-hand side. For MSERA as a whole, the contributions will not go down if you had a 5% gain and you're fully funded, because you can't reduce the employer contributions will not drop below that level of the normal cost. For the county, there's downside, there's no upside. Even for Novato, there's still upside and downside, right? Because they're probably right on that threshold of getting back to 100% funded, a 5% loss, 5% gain. They're still going to see some impact on their unfunded liability payments, right? And then San Rafael, they also don't have as much upside because, again, they're supposed to be closer to 100% funded at that point. So this is really showing you how different the picture is, especially for the plan as a whole and for the county. On the left-hand side, there's still some upside if you exceed your assumed rate of return. On the right-hand side, there's no upside for the county in terms of their current contribution rate. There may be other upsides, but you're not going to reduce their current contributions once they're above 100% funded. Okay. One more slide before I turn it over to Bill. You know, we always talk about what does it look like if all of your assumptions are met? Well, this is a simulation of what happens if your assumptions are not met every year. And in particular, what happens if we simulate your investment return portfolio over the next 15 years? What does the projections of your liabilities, your unfunded liability or your surplus look like? And you can see that there's a lot more, anything below that $0 line, that's surplus. That's where your assets are exceeding your liabilities, right? And you see a lot more potential on the upside for increases in surplus than you see on the downside. Now, the reason for that is we're close to 100% funded. If you have losses, the contributions will go back up, right? And start paying down that unfunded liability. If you have gains when you're 100% funded, the contributions can't fall, right? They can't fall any lower than the normal cost. So those surplus assets continue to earn expected returns, which will increase the surplus. And that's why you see that the upside potential continue to increase where you have a larger and larger surplus. With that, I'm going to turn it over to Bill to talk about, okay, what do we do to address this?
Thanks, Graham. Good morning, everyone. So actually, the first thing I wanted to say is we put surplus in quotes here because surplus has a lot of different meanings. And we're using it for short to say you have assets greater than the liability we've measured. That's not the same as you have extra cash you can do whatever you want with, sort of thing. So we're using that terminology through here. Just be sure you keep that distinction in mind. So how can the board use the assets above 100% funding? Well, the first thing that is often done is to reduce contributions. But as Graham has gone through, the minimum contribution equals the normal cost until 120% funded and a bunch of other conditions are met, which I'll talk about a little bit on the next slide. But so you can't really reduce the contributions. The member contributions continue at the same level unless we do some changes in assumptions or change the discount rate. Those could affect the member contributions. We could adopt even more conservative assumptions. So that would use up the surplus because if we, for example, if we reduce the discount rate further, that would increase our measure of the actuarial liability, and that would use up some of the surplus. We could just let it float and create a cushion against any future losses. That's kind of the current policy and the way things are designed. The other thing we could do is reduce investment risk, usually through a more conservative asset allocation so that you're reducing the risk of loss. We'll go into detail about issues around that approach as well. So using it as a cushion, first, Graham went over this quite a bit, so I'll touch it quickly. Contributions can't go below normal cost until the plan is at least 120% funded And as I understand it, the actuary determines that continuing contributions could result in tax disqualification. I've been an actuary for 40 years now. I have never made such a determination. And I don't know how I would determine that without the help of someone like Ashley. But any surplus there is going to provide some cushion against future potential losses and help you maintain that normal cost level of contributions. So that cushion has value, but larger and larger cushions have less and less value. So if you're 120% funded, you got a 20% cushion, that may be fairly valuable. 200% funded, I'm not sure how much additional value you're getting out of that. The more you build the surplus, each additional bit has less and less value. So the other thing that a lot of systems look at is reducing investment risk. And with the traditional approach, you just move to the left on the efficient frontier, reducing the volatility of the portfolio. That reduces the risk of poor returns and losses, but it has a cost. It lowers your expected return, which then if we reflect that lower expected return, that's going to increase your normal cost. And that actually is going to increase both member and employer contributions, which seems like the opposite of what you want to do when you have a surplus, right? So those trade-offs may not be attractive between the increased costs you'd have to do compared to the reduction in the risk. So the concept we've come up with is a way to kind of work around those parameters and make it so that if you want to reduce the risk, you don't have that incurred higher cost. So the primary objective here is to allow the use of a more conservative asset allocation to stabilize the funding level without increasing the normal cost or member contribution rates. And secondarily, we want to make it as simple as possible. I'm going to take a little bit of a detour here to look at how you are paying projected benefit payments. I think it's a little bit insightful as to how this methodology works. So you have to make benefit payments in cash from the plan, right? And so this line here is showing the projection of benefit payments for the next, 30 years. The first source of, whoops. If I can find the mouse here. The first source that's often used is contributions, right? You have contributions coming in cash with each payroll, and those can be used to pay the benefits that are going out with each payroll. Beyond that, you have to rely on your investments. And so here the gold is those projections of contributions that Graham was showing you only in dollar terms. And so you have to make up for that difference between the contributions and the benefit payments from your investments. Now, some of your investments produce income. You've got 23% allocated to fixed income that produces income as you go along. And so you can use those. And I don't know the specifics of how yours breaks out, but then most of your portfolio, almost 80% of the portfolio is liquid. So you could sell an investment on a given day in order to get that cash. You also have some illiquid assets, but that's part of how you manage the overall portfolio.
Bill?
No question.
Yeah,
Yeah. Why the big drop in 2032, 33?
that's that drop in the contribution when the amortization payments on that significant base from 2008 go away.
Thank you.
Okay, so now I'm gonna work with a semi-made up example. I just granted the plan enough assets so that it's 105% funded instead of 96% funded. And so in our single valuation, we'd have about 3.8 billion in liability and almost 4 billion in assets in this example. The split valuation approach, you would choose a target funded ratio where you want to implement it. Could be 100%, could be higher than that, could be lower than that if you wanted. Any assets above that target funded ratio, that 5% in this case, can be used to pay for the lower returns on high quality fixed income securities. So we're assuming 6.75% on the whole portfolio, right? Your diversified portfolio. High quality fixed income securities aren't going to return 6.75%. They're going to return something lower. And for this example, I used the LD-ROM rate Jeff referenced of 5.5, which is a high quality corporate bond yield rate. But so you can use that surplus to pay for that difference in expected return and invest in those high quality fixed income securities. Now, our notion here is we wouldn't ask the investment consultants to match specific benefit payments. Instead, we would ask them to invest in high quality fixed income securities and then tell us what the cash flows are out of that. And then what we're going to do in the valuation is we've got projected retiree benefit payments, and we'll subtract out the ones that match those cash flows. And we will match them and value those two pieces separately, and then the remaining portfolio. And so what that does in this example, because the bond yields 5.5 and the assumption 6.75, and we had a surplus of 5%, we estimated approximately that you could move 1.7 billion into a fixed bond portfolio, matching some of your retiree liability, and then you leave the remaining 2.3 billion in the diversified portfolio, and that matches up with the rest of your liability. So essentially, you've gone from saying that your overall liability is 3.8 billion to now your liability is 4 billion, and it matches the assets, but the assets are split between your diversified portfolio and this fixed income portfolio. Does that make sense? So here's just the example numbers underneath. So starting with the diversified portfolio, we have a surplus of 190 million, basically a funded ratio of 105%. And this is where I do want to point out, you've got a normal cost rate of 23.25%. That normal cost rate gets split between the members and the employers. But if that goes up, the contributions for members and employers are going to go up. And if we did the same investment strategy I just described, but kept it as a single valuation, that de-risked portfolio would now have an expected return of 6.34%. Your UAL would be 0, but the normal cost rate would have gone up to 25.66%. So your normal cost rate's going up about 2.4% of pay, just because you got more conservative in your asset allocation. Under the split valuation approach, we're trying to avoid that. And so the matching portfolio piece has an expected return of 5.5, but its UAL is 0. It's funded at 100%. The diversified portfolio still has 6.75. Oh, and the matching portfolio is all retiree liabilities. It does not have any actives in it, so there's no normal cost associated with it. It's just retiree liabilities. The diversified portfolio has all the actives in it. It's valued at 6.75%. And so the normal cost rate stays the same at 23.25%. So we don't get that increase in contributions for being more conservative. Now, overall, your portfolio is going to have a lower expected return.
Question? What is, I'm sorry, what is the, I missed, if I missed this, what's the de-risk portfolio? What's the asset allocation of de-risk portfolio?
For this example, I just used the same portfolio we had in the split valuation approach. So all of a sudden, it's just got a much higher fixed income allocation. And so that 6.34 is really the expected return on the combined of the matching and the diversified. If you're keeping that, if you're treating that as one portfolio and one expected return.
So, yeah, it would be significantly higher fixed income. What?
Yeah.
I mean,
Yeah, and this is an example,
and
not,
I may be jumping ahead here, but what happens if interest rates change? And you can't get 5.5% on a match, on your matching portfolio? What do you do? How do you adjust?
yeah, can you
Okay.
hold that until
Okay.
we,
Got it.
till I go through a few pieces here?
Bill, if I can just chime in, I just want to be conscientious of the time. We've got about 10 minutes left, so just keep that in mind as you think about what's left in your
Yeah.
presentation. Thank you.
So one of the things that happens here is now, if you have a 10% investment loss, if we kept it the same way we're doing it right now, this chart is showing how contribution rates would increase with that single 10% investment loss. By going to the split valuation approach, you have, in this example, you have a lot fewer assets exposed to that diversified portfolio loss. And you also have the ability to unwind the matching portfolio and swing everything back to the diversified portfolio, depending on your choices. And so the split value, the whole point of this is really to reduce that downside risk. And that's what happens here. Now, if you keep the matching portfolio as a matching portfolio, it doesn't actually matter what the return is on that portion of the portfolio because we're just matched to those benefit payments. And so if interest rates go up or down, it doesn't really matter. Once the investment has been made, the match will continue as long as you don't have significant defaults in those investments, right? The cash flows will be made as long as the bonds, there's no default on the bonds. So you've got some default risk, but that part doesn't matter. But when you implement it, the difference, the interest rate difference between current bond rates and your expected return is very critical. So it's much cheaper to do this when we have a 5.5% interest rate than it was when the interest rates were down around 2 or 3, right? So this was the projected cash flows with a single valuation. All we're doing really here, and in my example, I spread it out over time, is you're creating an income producing asset. You're investing in an income producing asset that's going to cover a much larger section of those cash flows. So just to wrap up, this is not something that's used by other systems yet. It's a new concept. There's a lot of additional investigation that would be needed before we tried to do this. There are some complications and Jim's getting at some of them and we definitely need to coordinate. And as I said, the efficacy is heavily dependent on the difference between your expected return and what current interest rates are. And so the closer those are, the more efficient this approach would be.
This, a little longer in mind, but the closest I've ever assumed rate of return to what you get.
Yeah, my career goes back further. Early in my career, I had a client that bought a guaranteed insurance contract that paid 14% interest. And they were wondering why we were only assuming an 8.5 or 9% return. But those days are long since passed. So any questions on this?
So of all the alternatives that we could consider, one thing that was mentioned was amortizing the surplus over a longer period of time than we've amortized the losses over. So I would be interested in a comparison of a policy of amortizing surpluses over, let's say, 30 years.
So you don't really have that option because of the minimum of the normal cost. You're forced essentially to amortize surpluses over an infinite period. So Graham was mentioning that for systems that don't have that normal cost limit and can reduce it below normal cost, then they spread it out so that they very slowly go below normal cost. But you have an absolute floor at normal cost. So the implication is effectively you have an infinite amortization on surplus.
Unless you get overall.
But if you amortize the surplus over a very long period of time, it has little effect on a year-to-year basis. So you can in effect reduce it from the calculations by just spreading it out over a very long period of time. And
Yeah, but we're not allowed to even take into account essentially the surplus in setting the contribution rate.
Yeah, this is the implication of the funding policy that's in place for PEP.
Council, Ashley, has there ever been situations where this has been called into question and that 120% threshold?
Or what has
Legal
been
cases?
called into question? So the legislature enacted this provision in 2013 under PEPRA, which is
Right.
requiring that normal cost always be paid unless the plan is 120% funded or over and various other preconditions are met. So your question is whether that's been challenged?
Correct.
Uh,
In court. Right.
no.
Thank you.
I think what's happened in the past when people have gotten overfunded is contributions were reduced, which turned out to be a disaster because people thought there was free money and so on and so forth. So the law was changed, so you can't reduce contributions.
Correct.
And the other thing that happened was benefits were dramatically increased. Okay, so that's the when there's a lot of so-called free money out there, those are the couple of things that that people want to guard against, as it were, because there will eventually be a downturn.
Right.
So I think that, thank you, Trustee Silverstein, for bringing those points up. Those are important. And I think that's why Graham and Bill pointed out that they put surplus in parentheses, because it's just the word to describe what happens when you're over 100%, but you're really never in surplus situation because there's a downturn coming that's going to eat that surplus up. And I would say that that what you saw in the past, rates go down, rates go up and down depending on the performance of your fund and other assumptions year over year. So if you earn more than you assume, rates are generally going to go down. That's just true. That's always happened. And if you earn less, rates are probably going to increase. That what to go way back in time into the early 2000s is when you have what appears to be a surplus, and then there is a benefit improvement that increases the cost, right? So it's a benefit improvement that increases the cost with the idea that the surplus will cover the increase in cost. And then the plan has a negative return year. So the benefit improvement just doubled in cost.
Right, right.
So the surplus will not cover the cost. Contributions will have to be raised to cover the cost. That's the event that's happened, is benefit improvements that were cost at a certain dollar amount when there was a surplus, that
Right.
dollar amount changed because returns didn't follow, because you had something like the tech boom
Right.
first, right after benefit improvements. Those just became more expensive benefit improvements. So I think that's the problem with talking about, and we talked about this with Graham and Bill ahead of time, is not trying to set something in front of you that makes it sound like there's found money, because there's no such thing as found money. Every dollar that we earn is valuable and is used to pay benefits. And you, this board, you are the financer of the plan, not the setter of benefits. Okay, so that's very important also, is you don't make benefit policy. The sponsors make the decisions about benefits, and then you figure out how you're going to fund those benefits. And this is just one new thing to put in front of you as food for thought. There are many other things that they talked about in the beginning that are other options you could consider. And there are probably even other things that we could consider if we ever get to that point.
Trustee Healy, did you have a question?
Well, I just had a question. If we were at 120, all the unicorns come true, we're at 120%, and we had another quasi great financial crisis, paid 25% market correction, that would just bring our liability down to say 95% funded. We'd still be pretty close to where we are today, close scraping 100%. Would it not be in our best interest to be able to absorb the next bubble bursting without having to really make major contribution rate changes? Are we trying to smooth the contribution rate to as low, as normal as possible over the longest period of time? Or do we normally correct up and down as the market changes?
So the answer to your question is the very last thing you said, that you correct up and down as you have actuarial gains and actuarial losses. In your first example, at 120%, what's being paid? Only the normal cost. Employees and employers are splitting the normal cost in PEPRA 50%, and in your older plans, roughly 50%. If you have a 25% loss and drop down to 95%, yes, it seems like you're in good position, but what's the cost now? Normal cost plus an unfunded liability payment that has to be paid by the employer. So you've added a cost in that situation. The funding may look great still, but you've now added a new layer of a new cost that's got to be amortized over your schedule. And that might not be a big impact year over year. So it might be that the rate doesn't move a whole lot, but it's still a cost that's been added to the plan.
But I think the choice that's really out there is you can build to 120% and use that 20% cushion as you described. That's one approach. The other approach is to use some of that 20% cushion to reduce the likelihood that you would have a 20% or 25% loss. And so if that's the approach the trustees want to take, that's where the split valuation approach comes in to deal with some of the negative actuarial consequences of taking that approach. So it's not, those are just two different ways to use the surplus to to address market uncertainty going forward. One is as a cushion, and the other is trying to reduce the risk of that outcome.
I back to my earlier comment that one of the best things that this board did was decide that you had an asset allocation policy, and after the great financial crisis, you were going to follow it. The other thing you did is in 2022, when you had a 33% return and you were at 106%, you could have eliminated the unfunded liability and seen that huge cliff drop off.
Hmm.
But universally, the board said, I think we're going to go ahead and let this roll the way we normally fund it, because if we have a negative return, which you did the next year, you had a negative 10% return. So you went right back into an unfunded liability status. The employer saw a little change in the rates between a 33% return and a 10% loss. And I think that discipline is governance. Instead of trying to do anything that times it.
All right, I'm going to cut it off there. Thank
All
you,
right,
Bill.
thank you.
And Graham, thanks for coming out. And next up, we have Jim Callahan with Callan talking about direct investments in private equity.
Just need to make a few logistical changes here.
Take your time.
All right.
Just moving things along.
Want me to launch it?
Yep.
Okay, good morning. Want to just reintroduce our colleague, David Wong. I think many of you have met David before. Some maybe not, but David is a senior member of our private equity research team at Callan. And the topic that we're going to discuss today is really different approaches to implementing private equity. There's a number of different ways that you see institutional investors implement private equity portfolios. So Dave's going to kind of walk through those different approaches, pros and cons, trade-offs, so things of that nature. Please ask questions as we go through this. And I'm going to do some color commentary along the way, but David's going to do most of the heavy lifting here, and I'm going to turn the pages. So with that.
Actually, before David starts, let me just remind you that this is the result of a rather lengthy discussion that we had back in September when you had your annual review of private equity and your commitments. And there was a discussion about how could we implement private equity differently. So this is a follow-up to that discussion from last September.
Yeah, thank you.
Great. Thanks, Jim, and good morning to the board. And it's great to be back here with you. And so what we've done is put together what we are intending to be an educational session, really to highlight the pros and cons of the different implementation models and help you understand what it would entail operationally, financially, and from a governance perspective to really move from your fund of funds model to a more of a direct model. And what the key takeaway here that we're hoping to impart is that there's no universally correct model, and the right approach really depends on your resource capability, governance capacity, risk tolerance, and desired level for control. So all those are things to consider. And so maybe a good starting place here is to revisit what we believe are the foundational building blocks of what a successful private equity program entails. And the four building blocks are program design, strategic planning, manager selection, and monitoring, and evaluation. And I would say that you've already worked through the program design and strategic planning phases in kind of coming to your current fund of funds implementation model. But now, as you think about moving to a direct model, you will also need to approach and develop the manager selection and the monitoring and evaluation pillars as well. And those are not trivial. Manager selection means that you will need to think about developing
a forward calendar of managers that you want to be investing in. You would need to identify your diligence criteria, think about what constitutes good portfolio fit, and then negotiate terms and conditions, legal contracts, side letters, and that sort of thing with the underlying GPs that you're investing in. And then from a monitoring and evaluation perspective, you will need to develop the processes for qualitative and quantitative monitoring of your managers. Think about benchmarking, performance reporting, and all the protocols that are involved in that. So, moving from this sort of represents an evolution from being a buyer of a product to being an owner of a robust portfolio construction process.
David, could I just chime in? And appreciate the understanding of how we might change, but is it correct to say that our private equity investments using the fund-to-fund model that we've been using have really produced some of the best returns in our portfolio?
Yeah, that was going to be something I was going to allude to later on, but because you're implementing through a really diversified approach using professionally managed an investment manager, you're getting very consistent returns. And the results have been really, sort of mid to upper second quartile over long periods of time. So it has been a successful approach.
Okay, I just want to, we're not trying to solve a problem here. We're just looking at a different way to do something.
There's nothing dramatically broken here or broken at all. No, not at all.
No, it's fair enough.
But there's different ways to
Yeah.
do it, right?
But I
And-
understand that we're not here like we got a problem. We're trying
Yeah,
to
yeah.
understand how we might change it. This is another approach for the board to consider, which would be a much more a kind of a hands-on approach.
Exactly.
Great.
More
Thank you.
control. Maybe
Yeah,
Potential.
exactly. I was just gonna say, as laid out here, that strategic planning, part of that is to select the fund-to-fund managers. They do the bottom part.
Right.
So what we're talking about here is that if you do it yourselves, then you have to do those bottom. So there's an added amount of expertise, governance, oversight that is, you're bringing to the table that's done by your gatekeeper staff.
And before, maybe on the next slide, before we kind of go through the pros and cons of each approach, I maybe want to highlight here that this evolution in implementation model will require some modifications to the investment policy statement as well, which is the document that governs the roles and responsibilities of everybody involved. And so the modifying the implementation approach means that the IPS under a direct program will have to be fleshed out a little bit more for policies and procedures for how to select managers and monitor managers as well. So I just wanted to highlight that before we get into the pros and cons. And the reason that we want to be very mindful about the processes and institutionalizing and in a robust framework is, one of the defining characteristics of private equity is the wide return dispersion. Right? So while going direct might lower the fee burden, right, and by eliminating the additional layer of fees, the range of outcomes is also so wide that you need to have these processes in place to avoid the situation where you're just barely beating a public benchmark and not justifying the illiquidity risks you're taking to be engaged in private markets. So implementation structure and manager selection are deeply linked, which is a reason to be having this session. So maybe on the next slide here, this summarizes the central trade-off between implementation models. As you well know, the fund-of-funds approach is the simplest. It has the lowest implementation risk. It's less complex, but it comes with higher fees, right? The additional layer of fees you pay to your fund-of-fund managers. At the other end of the spectrum, direct programs reduce costs. They may provide better net of fee returns. They give you the ability to customize portfolios, but they have high implementation risk and come with high complexity. And again, I was going to say to your point that your fund of funds there's nothing broken with it. It has proven to be very consistent over time. But a direct program offers you more control, customization, the potential to outperform, but also at the risk of underperforming as well.
There's
So-
the potential to outperform and the potential to under do it. So.
Yeah. So that's the trade-off the board needs to consider. And on the next slide here, we maybe just since it's worth understanding your current implementation model to really know to understand in some depth as to what your fund of funds managers do for you. So you commit to a fund of funds manager who then takes that capital and deploys it across multiple underlying PE managers. And I think at the Abbott 2022 program, which is kind of a mature program, has about 50 underlying partnerships. So just to give you a sense of the complexity, and about 75 underlying investments across primaries, and secondaries, and co-investments. So lots of different line items. And the fund of fund manager does everything for you. You write one check, they give you broad diversification. They handle the manager selection, cash flow management, portfolio construction, and all the legal and administrative tasks, including audit and tax that are laid out at the bottom of the slide. And so all you need to do is think about your annual commitment pacing, and they basically take care of everything else. And that comes at a cost, right? You pay them an additional layer of fees. And so, the other con to think about this structure is that, again, you don't have any control. There's no ability to customize to a certain extent. And then the fund of fund manager owns the relationships, right? And you don't have those, even though it's your capital. And so that's one thing to consider, sort of for the long term, is that this could be a strategic asset that you're not currently building and developing.
Oh, we've got a question?
Sure. David, thank you for this. Just a quick aside, is it the intent on the private credit portfolio to follow this structure?
No.
No? Okay, we can talk about that some more.
Yeah.
Great, thank you.
So yeah, one of the big takeaways I think for me on this slide is that the functions that are listed here that the fund manager does, those don't go away if you do it directly, nor do the costs of doing those go away. And nor does the time to do it go away. It's just a matter of who does it.
Is it worth drilling down a little bit as to what those entail, or you can just maybe I'll do it on
Yeah.
in the context of the next slide. So this is what it would look like if you went direct. So all of those tasks that Jim mentioned become unbundled, in that you or your advisor in some capacity would have to handle those directly. And so here in this case, you would be committing to underlying partnerships, as I mentioned, that through Abbott 2022, they gave you access to 50 underlying partnerships with one check. So you would have to somehow replicate that individually. And that's it's not trivial. So, from a legal standpoint, you would have to review and negotiate PPAs, LPAs, side letters, engage legal to do that. So it's a administrative lift. From a admin standpoint, you would have to manage all the capital call process, fill out the sub-docs, handle all the reporting, reconciliation, the statements, do the performance measurement and reporting. Again, for just one vintage had 50 underlying partnerships, but you would probably over time accumulate a lot more underlying GP relationships. So just wanted to kind of lay that out. in terms of the administrative infrastructure that would need to be built out to a direct investment.
Yeah, not inconsequential. by any-
So the next slide just kind of lays out side by side all the different options here. What, I wanted to highlight here as well is that, in between the hybrid structure has been an implementation model that we see increasingly with mid-size plans, and even some larger plans as well that we actually currently serve in that capacity, where we're helping them develop a primary investment program while they still have underlying fund of funds. So, these implementation models don't have to be exclusive, and the hybrid approach can be a good way to, sort of manage the transition away from the fund of fund approach and build relationships, institutional knowledge over time.
And can give you a little more, if you were to decide that you wanted to have more customization or focus on a particular type, you might be able to get that through a hybrid or direct program, maybe more than one. Although I would say that over time, both AB and Pathway, your fund of fund managers, have created modules that give you some flexibility in how you implement. But certainly the hybrid and the direct approach would give you more customization if you were to have it. To date, there really hasn't been any desire or need to do anything more customized. I think the approach has been, let's build a diversified portfolio. Let's be consistent about allocating and committing to it. That's worked well, as we've pointed out. And so the need for customization hasn't really been there. That's not to say it couldn't be needed in the future.
And each one of these implementation approaches still has trade-offs, right? As sort of we've talked about already, fund of funds emphasize simplicity, direct programs emphasize customization, hybrid structures can balance both, but there's no right model. It all sort of depends on, again, as I mentioned, the governance capacity, staff resources, and the board's long-term ambitions for private equity program. So we hope this is in the context of helping you decide what each path entails. I hope that this is helpful here. On the next slide, we lay out what we believe are the key sort of dimensions to consider as you think about which path you want to take. Of these, I would say governance, decision-making, internal resources and expertise, and risk profile are probably the most important for you to consider. The others, you could use, specialist consultant like Callan to help you along the way, like what we already do with pacing, for example. But from a governance perspective, this is the most important because moving to a direct program would require that you, the board, approve individual fund commitments. So you would need to be much more active. You would have to assume more of a fiduciary and oversight role. Internal resources and expertise, I think, is the next most important. Does MCERA have the capacity, or can it build staff capacity to support a direct program? And this can be the most binding constraint for smaller mid-sized plans. Risk profile here, by this I mean that the board would have to take a much more active role in the allocation decision, right? How much, if you do go direct, how much to allocate to buyout versus venture versus growth, how much to think about geographical exposure, rather than accepting sort of a prepackaged mix that come in the fund of fund construct. And then the others, as I mentioned, are things that you could get help with in terms of portfolio construction, access. This is the business that we're in. It's just providing access to good quality GPs to think how to think about pacing over time, and vintage diversification. And then as you evolve, we could also, or your specialist consultant could also help you think about deploying co-investment program, which is sort of the next sort of enhancement of the program where you can invest in individual assets alongside a GP at zero fees, essentially. So these are just some, we leave you with these as key, sort of dimensions to think about as you ponder which path to take. On the next slide here, this lays out if you were to go direct, the additional governance infrastructure requirements compared to your current fund of funds program here. Under a direct program, you would have to, again, as I mentioned, the board would have to approve individual fund commitments. And so, you would have to ensure that you have resources and processes in place to help you in those decisions. You don't have investment staff, but as you think about developing investment staff, you would need to think about staffing up to manage the number of GP relationships, that would monitor individual funds and performance and coordinate capital call activity, that sort of thing. From an administrative perspective, you would need to think about enhancing that infrastructure as well, because you will have multiple line items, multiple capital calls, need for various PE reconciliation, audits, that sort of thing. And so, again, it becomes a little bit more burdensome, requires more of an infrastructure than is currently in place here. So the bottom line with this slide is that it's, moving to a direct approach is not just an investment decision, it's an operational commitment. And that's something that you need to keep in mind.
David, if I understand you right, I think what I'm hearing subtly is actually it would shift a massive amount of responsibility to the board. In the event something goes wrong, we have a fiduciary duty, of course, and if we are taking on this extra risk of trying to do what the fund of funds is doing for us, it does kind of, I think for all of us, we have to recognize that would be shifting a liability to the board that I think we're doing a really good job of delegating. That's something to me that resonates more than all the operational stuff, which could probably be pieced together maybe. It does put a lot of responsibility on us if there was a problem. If everything goes great, yeah, it doesn't matter that much. But thank you.
There's always investment mistakes, but if you have a robust institutional process along the four pillars that I mentioned at the outset, you could use that as a sort of a defense mechanism.
Ashley's going to
So
turn.
your fiduciary responsibility is the same regardless, in the sense that the buck stops with the board, you are the fiduciaries. The issue is, how are you managing those fiduciary responsibilities? And now there's a substantial amount of delegation of certain aspects of this, where the role that you retain is that of oversight and monitoring. Now, even in direct investment contexts, there are boards that will delegate, but they are typically delegating to investment staff. That's a big topic right now nationally and in California. But what I'm hearing is that there are various different elements to this that are quite different from what you currently have as an organization, an ability to effectively do. But the fiduciary responsibility is always there regardless. It's just how you manage it.
The additional thing you're getting through the structure you have today is fund of fund managers that are acknowledging that they're acting on our behalf as a fiduciary.
Correct.
So we have that legal requirement for them.
Sure.
You still sit over the top of that. You have that, but the fact that they are supposed to be making all their decisions based on acknowledgement that they're acting as our fiduciary is an important legal protection.
Oh, another question? Yeah.
Yeah, and those, when we say staff, those staff could also be outsourced. I mean, in this model, this,
And to a large degree, that's what you're doing already. You're fund to fund.
I mean, because there is.
All of those staff functions that are being described here are being outsourced to a fund to
I
fund.
understand,
But yes, if you were to unbundle it from a
Yeah.
fund to fund model,
Uh-huh.
you could outsource some of these functions for sure.
There,
Right.
there's an implicit legal question there about the outsourced CIO and whether that's, to what extent that is permissible under California law. I'm not going to get into that here, but i-
Oh, so there are rules.
there are
govern that.
absolutely rules.
Got it.
And unlike certain ERISA plans, for example, where you can fully delegate fiduciary responsibility, you can't for a governmental plan. So you're retaining it. And there are a lot of issues implicated in what this approach that's being presented.
And this comment is not to say that all of these things are in play, because they are, but there are things that we do today. We handle capital calls, we handle distributions, legal reviews, the limited partnership arrangements, and we make an attempt to try to negotiate. We're in a lesser position because it's already being delegated to us, but we do make that effort. We review the private placement memorandums also. So some work goes on with this, but there would be more that goes with it. And the impact from my perspective, purely operational, is the back office function, or what, and I hate to diminish that because that's a lot, but the accounting piece of this at the GP level would be way beyond anything that we're doing today, when we're only having to account for what the fund-to-fund manager is telling us they're accounting. And the best analogy I can give for this is when Callan comes in and presents you that fee review and shows you all the fees. We're accounting at the fund-to-fund levels. We'd have to be accounting for all of those other fees that are being, so there would be a significant operational, accounting, finance impact to doing that and to having layers of GP.
Question. First of all, thank you for this research, especially the few slides you got coming up when we compare ourselves to the peer groups. That's very insightful. I know that I have raised issues about the execution of our private markets program, both prior in our private equity and then now future, going into our private credit. I'm just curious if you have ever come across the research by a gentleman named Keith Ambekshire, where he evaluated 132 public pension funds in the past between 2006 and 2015. Basically came up with the conclusion that by insourcing many of these functions, it produced across 132 public pension funds a savings between 60 basis points and 150 basis points. I'm not saying that that's what we should do at this point, but I'm saying that's something that we should consider, I believe, actually going forward. For those, for a plan our size, using the 3.9 billion valuation, that's an annual savings of about 234 million and 585 million. So I know we pay our funds of fund managers to basically do all these functions, but the cost benefit analysis, I think, is leaning in that direction if you believe the research. So I'm not suggesting that we haven't done a good job, phenomenal job. Credit to our funds of fund managers, credit to Callan in selecting the fund of fund managers and keeping us disciplined. But I also know that private equity has some serious challenges going forward as the asset class and the industry itself is maturing, particularly in the rising interest rate environment. So, just your thoughts on the potential savings of starting with the hybrid model and then going forward. I think that's real money. If you believe the research, which I tend to do, coming from an academic background as well. So that's just my thoughts.
I mean, the fees are real.
Right.
And so the potential fee savings are substantial, but I would also tie it back to, I think, slide 4, where you look at the dispersion
Sure.
in returns. And so lower fees, I don't think necessarily translates in better outcomes, right? And so I think that's the other
Correction.
consideration as well.
I do know the distinction between fees and investment costs. I actually meant investment costs. So you're actually accurate, but I misspoke. It's not just fees. It's the total investment cost and the cost in operating this model, which
Again,
arguably is what we,
I'm not familiar with the particular study or citing or the outcomes from it. I
Sure.
mean, your gatekeeper fees are in the kind of 40 basis point range, kind of what you've aggregated to. So again, if you were to move away from that, you wouldn't pay 40, but you're going to pay something, right? You're going
Right.
to have to pay additional staff to do this. I mean, I think, it's been mentioned, but worth reiterating, and we'll get to this about the peers, but pretty much everyone that we're aware of institutionally that does it direct has dedicated investment staff for private. So there's a staff cost, right? There's then, a consultant cost to do the sourcing, picking managers. So again, you're not saving that entire 40 basis points. You have the potential to reduce it, but then you also run the risk of the dispersion of the return in the portfolio. You've got managers that have executed pretty well for you. We're still confident they can do that. And so there's a risk in kind of doing that that goes beyond just the dollar cost. And it's easy to point to. Everyone understands it. You can see the dollars, it's public, but I think the
execution
whole
risk.
point is it's a little more nuanced and that the net of fee performance is really the driver for this. And there's a lot that goes into it.
that's fair, Jim.
Yeah, and as you alluded to, the next 3 slides are an attempt to, sort of show what your peers are doing, how they're approaching private equity implementation. And maybe, you fall right in the middle of the pack there. Actually, go back to slide 11, 3.6, 3.7 billion in AUM, you have 8% allocation to PE. So the range is, 5. Actually, Sonoma has 0, but 5 to 16. So you're right in the middle of the pack in terms of exposure. The next 2 slides, however, show some differences in how plans are resourced. Here, 82% of these plans have dedicated internal staff. 45% have an internal CIO, and the majority, 55%, tend to use the second consultant or specialized consultant. And so, again, in terms of resourced, these plans are quite a bit different from where you are. And then there's a bit of a pattern we notice as well too, that some of the larger, maybe more mature, more resourced plans like San Mateo, Fresno, Ventura, are the ones that can afford internal staff and have developed infrastructure. So it's a bit of a correlating factor that more infrastructure can be more predisposed to a direct investment model than plans that do not have internal resources. But I think the overall sort of overarching message here too is that it is no one correct model. It seems like the implementation approach and the staffing and resources, are really sort of dependent on each individual plan's governing philosophy and sort of long-term mindset. Yes.
If I may add to, Jim, your point is well taken about the implementation and the execution on this. And I do believe in delegation, by the way, especially if it's worked and if it's performed and the returns are there. But I want to ensure that we don't delegate so much as to the point of abdication, where we overlook some things, especially in an asset class that, for all intents and purposes, in the past has been effective working in an opaque environment in private markets, right? There's less transparency. We know that. The illiquidity premium that we've enjoyed and the rest of the market has enjoyed at some point can be an illiquidity risk. So the fact that it is opaque, that opacity and delegating in that context of opacity, I just want to ensure that we don't abdicate our duty. That's my, thank you.
Can you go back?
Oh, we got a question, Trustee Healy?
So our peer group, it seems like the primary, a lot of them have gone to this primary model where they're directly investing, if I understand. But have they seen a significant improvement in their returns net of fees that we're not enjoying, that we're missing out on? Given the fact that we don't have the same complexity in overhead and operational complexity that we would then have to deal with?
I don't know if we have sort of a robust data set to prove that, but the only thing we can point to is when we do measure your plans for, it measures, this is the mid to top second quartile over long periods of time. It kind of tells us that your approach is definitely above median, the entire peer.
But we're probably limited in the data to be able to compare the returns relative to the other ones. There's timing issues, there's a whole bunch of other issues that would influence it. Nor do we really are able to evaluate their performance in going from a fund-to-fund model to a primary model. And did that lead to performance improvement or performance deterioration? We just don't have that.
Okay. We had another question.
And follow up on that. So the slides 12 and 13 clearly shows that most of our peers are using the direct model and the primary. Is it perhaps because they have that in place for the entire portfolio, not only for the private, that affects their decision to use those existing staff on site, I mean, in-house? Is it that, or just purely decision on the merits of the strategy?
Yeah, I mean, this may be even a question Jeff can chime in on there. So the question is, if you say, I want to go primary because I think that's the preferred model, do you then hire staff to help you do that? Or is it a function of, hey, we've got a lot of talented staff here, we can take it on, right? So is which is the cart before the horse kind of thing, right? Which is which? I don't know. It probably a little bit of both, depending on the systems. And I can't speak to these. None of them are clients. So it's hard for me to.
I think the data that we asked about that we don't have could shed a good light, because this is contradictory, because we're doing well with the fund to fund, and sounds like most of them are not. I mean, are not in the fund to fund, but I don't know how they're doing.
Yeah, again, to David's point, though, we do measure performance pretty carefully here, and we compare it to a database of private equity partnerships, which are the same partnerships that these funds are going to pick from. And you've consistently ranked favorably in that peer group. Are some doing better? Perhaps. But your returns are very competitive in that regard. That's just the Marin experience, or their experience. Hard to say.
Thank you.
And again, that's also, I talk about timing because that's going to be important. Yours is a very seasoned program now, right? You've been doing it for 18 years. I don't know when all of these systems moved to primary, if they moved from fund to fund to primary, or they just started with primary. How seasoned is that? There's all those factors that would go into, if you were going to really do a detailed attribution or evaluation of performance, you would need to really be able to draw any good conclusions, in my opinion.
Maybe I can help tie some of these up, if you can go to slide 11. Okay, so we're talking right now about assets But remember, you can't divorce that from the thing that Graham was just talking about, liabilities,
That's right.
right? And you have to figure out based on your liabilities, how you're going to fund the plan. And that's going to implicate your decisions about assets too, isn't it? Right? So I can tell you there are at least 3 systems on this chart that have, this is just private equity, that have total private markets at 30% because their funding levels are in the 60s and 70s. In other words, they need to earn money. You're in your 90s, you're doing great. This program is complementary. It's had a great return for it. There is no right or wrong. People make decisions based on what they are trying to achieve, based on what their liability is, and what's the best way to deploy the assets to try to meet that liability. And those decisions are baked into these charts. So people make the same decisions you're making about how you're going to allocate and how you're going to oversight that, but they're going to base it on the whole thing they're looking at, liabilities and assets and ability to manage the assets. And those things are baked into all of these charts that they've just shown you.
Yeah, I think my takeaway from the presentation is frankly that we have the right approach and they probably have the wrong approach.
I did not.
Well, I'm just saying.
I did not. That was not the point I was making. The point I was making is that when people are looking at how they are going to improve returns, they may be looking at private markets and they be allocating more money to private markets. This is a point that's come up multiple times. Trustee Vasquez has brought up is how much money is moving into markets. Well, people are making decisions about that and coming up with the best way to try to deploy to that. I am not saying they're wrong about how they choose to deploy.
I was speaking of our funding levels and the strength of our investment returns have been exceptional compared to our peers, I think, or in the top quartile. So, I think just because everybody's doing it differently, I don't think we should feel like, oh, we're doing it wrong. And there's nothing to say that we could even do it better if we tried to dig in and recreate what the fund-to-fund managers are doing for us. I think Jim makes a great point. The 40 basis points fee is probably the smallest fee in that whole layer. And it might be the most valuable money we're spending as far as what we get and then what we don't have to do or recreate. So,
Right.
But
I also think once again, what I tried to say a minute ago is when you implemented private equity and you did it at an 8% allocation, it was complementary to the rest of your program. What you may be looking at is where it's more of a driver of some programs, right? Whereas here it's complementary and it's helping you to achieve your returns through your other allocation.
I think
if I could just be conscious of the time, I'd like to take a break before our 11 o'clock presentation. So I'm not sure, Jim and David, are you close to wrapping up? If so, we could take a break.
We can wrap up.
That was kind of it. I think that you wanted, did you might just want to walk through maybe like this? Just
Yeah.
He had couple other slides here and an appendix.
Yeah, just the next 2 slides,
Sure,
I think,
yeah.
are just some additional sort of practical considerations to be mindful of if you're thinking about moving to a direct program in terms of individual investment decisions, right, and approvals. And so here we kind of map out by plan size and private equity target, what that typically means in terms of annual commitments and decisions to be made. So you kind of map out in the sort of medium plan size, 3.6, 3.7 billion, call it 300 million in target private equity NAV. I think we did project 70 million in annual commitments, which, assuming 10 to 20 million bite sizes, that's like 4 to 7 individual approvals per year. Probably a lot more if you wanted to kind of sort of build in more diversification. So that's sort of the scale of your involvement in sort of making individual approvals. And then on the next slide, just to add, more complexity, right, in terms of sort of the allocation decision that you would need to be sort of responsible for too is, how much to go to all the different sub-strategies, buyout, venture, and growth. I don't even mention geographic exposure here. And then, in time, you would probably want to consider, secondaries and co-investments as well. So the direct path entails a investment process infrastructure that would, you would need to have an investment process infrastructure to help you make those decisions.
So, I mean, there's a lot that goes into thinking about this, right? We work across the spectrum with clients. And really, I think it's our job to, try to get you to a place that makes the most sense for your organization. And I think the model you're in is a good approach for you. It's worked. Said that nothing's really broken. But it's good to, consider these types of things and revisit this decision, frequently, because that can change certainly. But where you are now works for MSAR.
We'll get one closing question. I
Yeah.
think Steve first, go ahead. Steve.
Just make one point. These investments are not liquid, so we couldn't change overnight from the fund of funds approach to the primary project. If we were going to change, we'd have to hire up and start all this stuff going on our own, and it would only apply to a small portion of our private equity investments because we have a long time, if you will, to unwind what we have now. So we're not going to save, if you will, 40 basis points from day one. It's going to take 10 years or something like that to get to that point. But in the meantime, we have all the startup costs of
Yeah, that's an
doing
excellent
it there.
point. It's you would move to a hybrid model first before you ever went to
Yeah,
fully
for sure.
direct.
For sure. For sure. Yeah, just final point. I think, Jeff, the distinction you made is probably the most important takeaway I've gotten from this presentation, which is for other plans, private markets in general has become a driver in searching for returns or searching for yield, as we say in the business. And for us, it's complementary. And so long as that we keep that front and center, that this won't become a driver of our cash flow so that we can pay our liabilities to our members, I'm very comfortable with it. Simply put, because the incentives, the industry incentives, when I say industry, I mean investment management industry, are such that the drive towards private equity, private markets is the greatest I've ever seen, at least in my career. And I just don't want us to get our eyes off the ball and just make sure that it's a complementary, not a driver for us, because we're doing well in our illiquid investments and we're doing. So that's all. So thank you.
All right. Well, thank you both for coming. We're going to take a break until 11 o'clock.
Thank you.
10 minutes. Kenneth Wilcox, and I think Jeff, you wanted to provide some introductory comments?
Yes, I do want to introduce Professor Wilcox. I also want to thank Trustee Silverstein for his work in getting us connected to Professor Wilcox. But just a little brief introduction that Professor Wilcox was the CEO of Silicon Valley Bank from 2001 to 2011. And then relevant to our discussion today, he was also the CEO of Silicon Valley Bank's joint venture with Shanghai Development Bank in Shanghai until 2015, followed by 4 years as the bank's vice chairman. He currently serves on the board of the Asia Society of Northern California, the Asian Art Museum, and the UC San Diego's 21st Century China Center, as well as Columbia Lake Partners, which is a European venture debt fund. He's also on the board of advisors for Fudan University School of Management in Shanghai and teaches as an adjunct professor at UC Berkeley. He holds his PhD in German from Ohio State and an MBA from Harvard Business School. He's also a former member of the board of directors of the Federal Reserve Bank in San Francisco. In addition to the book that you all received a copy of, The China Business Conundrum, he also wrote another book, Leading Through Culture. So with that, I will turn it over to Professor Wilcox.
Thank you very much. And if you don't mind, I'd like.
That's great. Yep.
I'm more comfortable standing at this point in my life. I would like to start with a quick story about Silicon Valley Bank. I would like to also beg your forgiveness. I hope that none of you lost money. At the same time, I would like to firmly declare that I was not responsible. So about a year and a half ago, in November, when my book about China came out, my publicist had arranged for me to speak with a reporter from Fortune magazine. This guy got on the phone with me and he said, "I'm so happy that you're willing to speak to me. We need 2 hours." And I said, "Why 2?" And he said, "Well, the first hour has to be about Silicon Valley Bank. And the second hour is going to be about the book you wrote." And I said, "I don't really want to speak about Silicon Valley Bank." I said, "Do we have to?" And he said something that I'll never forget. He said, "Ken, you're like a man with a chicken sitting on his head. And nobody is going to listen to anything you say about China until you can explain why that chicken's up there and how to get it down." So with that, I do want to spend 2 minutes on how Silicon Valley Bank went down, just to clear the air and feel better. It had absolutely nothing to do with our business model. Our business model was perhaps one of the most unique business models of any commercial bank in the US at any point in time. 100% of our business, or very close to it, 99+% of our business, involved providing banking services to technology companies of all sizes, or providing banking services to venture capital funds. And when I was left my position as CEO, which I left at the end of 2010, so a full, I'll point out, 13 years before the bank went under, we banked about 2/3 of all the technology companies in the US and about 70% of all the venture capital funds in the US. I'm unique among the groups that I speak to, probably will understand quickly what happened. There were excess deposits in the bank, fundamentally because in the wake of the onset of the COVID, the Federal Reserve was flooding the market with liquidity, way more liquidity than we had any use for. So our loan to deposit ratio, which we always kept at 80%, meaning we'd lend out 80% of any deposits that came into the bank, the loan to deposit ratio shifted from 80% to about 20%. Now, if you think about that, there are 2 reasons how that could happen. ways that could happen. And it didn't happen because the loans went down. The loans stayed more or less constant. It happened because the deposits went up. We went from 50 billion in deposits in 2019 to approximately somewhere around 250, maybe 300 billion in deposits a couple of years later. The problem with that is, forewarning for all of you, if you're a bank with excess deposits, get rid of them. Do what we used to do when I was CEO. When we had excess deposits, we'd convince the clients they were better off putting them with Federated or Fidelity or somebody who knew what to do with them. But it wasn't our business. Our business was taking deposits and lending them to technology companies. But the management team in the 20s, 21, 22, 23, decided in their wisdom that they would deploy those excess deposits. And so they put them into long-term interest-bearing treasuries. So you, I'm sure, know how that works. If you buy a long-term interest-bearing security and deposit rates go down in the market, your security is worth more because you've got a higher deposit rate on it. On the other hand, if you buy a long-term interest-bearing security and interest rates go up in the market, the value of your security goes down because people could get a better deal going elsewhere. And the result was Silicon Valley Bank accrued massive losses on paper because they weren't selling those deposits. But these massive losses had to be reported. As soon as people found out about it, which they were going to because we have a legal obligation to report, there was a run on the bank. And it was a run that lasted less than 72 hours because of social media. I actually, ironically, experienced a run on a bank in my first job at Bank of New England, but it took 6 months because there was no social media. So in any case, that's the story of Silicon Valley Bank. I truly hope you didn't lose money. I'm very sad to say that almost all of our 8,500 employees lost their entire savings because they had almost all of their savings in Silicon Valley Bank stock. And the government lost at least $20 billion. And the shareholders lost at least $20 billion. So it was a disaster. Either the second or third largest in US banking history. Ironically, because for years, we were 40 years old when we died. For years, Forbes magazine off and on rated us the #1 or #2 or #3 bank in the US out of, at the time, about 6,000 banks. You can all hear me. Is that not right?
Yeah.
Okay. Well, I will get to the point. What I want to do is talk to you about how business is done in China. Because I think you need that backdrop if you're going to make any decisions about how to invest in China or if to invest in China. And I will end by telling you why I would not invest in China. And I'll go as fast as I can so you have time for questions and answers. But I do think it's useful to know how business is done in China. We started going to China when I became CEO in 2000 or 2001. The reason we did that is because I made fundamentally only 1 or 2 decisions, big decisions, in my tenure as CEO. One of the big decisions, and the most important one, was that our bank should go global, which is something banks typically don't like to do because it's very risky to take your bank to other countries. And there aren't that many global banks. Out of about 5,000 banks in the US today, there are probably only 10 or 15 that are global in their orientation. But I felt it was really important because in my opinion, technology is the only industry I can think of that is inherently global, meaning technology is all about being cutting edge or building something that is cutting edge. And if you're not cutting edge everywhere, you're not cutting edge anywhere. I felt that if we didn't take our bank to the innovation centers around the world, somebody else would take theirs there, and it would bleed back into our market dominance in the US. So we began with Israel. We built a fine organization in Israel that banked a huge number of technology companies and did very, very well. We went to the UK and we built a very large bank in the UK that served all of Europe. We went to India. India was more difficult in some ways because the regulators in India are very protective of the banking market. So we weren't able to build something big, but we did build something small that worked very well. And we ultimately decided that we wanted to go to China. So here's how that came about. In the first year of my tenure as CEO, I was invited to speak at the first meeting of the Chinese Venture Capital Association. I was excited. I went to that meeting, I spoke, and then I used the opportunity to travel to the various innovation centers that were in their infancy at the time. They would have been Beijing and they would have been Shenzhen primarily, to a certain extent, Shanghai and also Suzhou. What I saw amazed me because I saw venture capitalists at work. I saw a large number of startups, and I saw some startups, all in technology, of course, that were very interesting. So I put a team on the board, on the ground. We sent about 5 people to China to live round the clock. And their goal was to meet members of government, because to get a banking license, particularly in China, you have to have relationships with members of government. Otherwise, there's no hope. And so that's what they did. They spent several years wandering around, meeting people, finding people who were members of government, which by the way means finding members of the Chinese Communist Party, because government is the Chinese Communist Party and vice versa. So they made some, I guess you could call, relationships in the first 8 years or so. They were doing what we in retrospect referred to as kissing frogs in order to find a prince. But they didn't find one until 2008. And in 2008, during one of my, every year I'd go for a couple of weeks to China to see if I could help them make any progress. And in 2008, I met a prince. I thought that it was my good fortune and diligence. It was actually not a coincidence. It was a setup. I'm going to grab that water. Thank you. It was a setup. I was sent to a party on a boat, one of those tourist boats in the river that goes through Shanghai. And during the party, a big burly man walked up to me, a huge grin on his face, and he grabbed my hand and he shook it. And by the way, by the end of the evening, he wasn't just shaking my hand, he was hugging me, which is rare because Chinese people don't typically hug strangers. And in fact, I studied Chinese for several years, and in the first year, we had a reader with chapters in it. And one of the chapters was entitled, in Chinese, of course, Chinese people don't hug strangers. So we knew there was something odd going on there. And in the fullness of time, I learned that that was all planned. I was going to meet him and it was going to be on that boat. He became almost attached to me for several years after that. It turned out this man, whose name is Chun Anjia, Chun Anjia was the party secretary of the Yangpu district. The Yangpu district is one of 19 districts in Shanghai, which is one of the, if not the largest province in China. At the time, it's a city province. So there are a couple of city provinces. It had about 25 million people at the time. And this guy was party secretary. Party secretary is always the top person in any jurisdiction, party secretary of the Yangpu district. He'd known about my bank. And I say my bank, it was publicly traded. It wasn't mine, but he knew about our bank, let's say, and he wanted it in his district because his district was Rust Belt and he wanted to transform it to an innovation center. So he spent the next few years introducing me to the most important people in terms of getting a license in China. And without his help, of course, it never would have happened. At this point, this is what I would like to do. I would like to describe to you in very broad brush terms our experience in China. I refer to it as the ARC. And that just makes it sound probably a little bit more scientific than it really is. An arc is nothing more than a curve on a graph. And the arc that describes any company's, any corporation's development, whether they're in the US or China or anywhere, and at whatever point in history, they all look the same. They go up, they peak, and they go down. And so it makes it sound a lot more scientific than it really is, but I want to describe our arc to you. And I'm going to be making a point that our arc in China is very similar to that of every other American or Western company that goes to China to do business. And I'll do that by describing three significant points on the arc. I'm not going to describe what happened every day. That would take forever and you'd be bored. But I do want to describe 3 points on the arc. And these points are significant because they're indicative. I believe that every Western company that goes to China experiences the same 3 points I'm going to describe to you, somewhat differently, and the space between points will vary by company. But here's what they look like. The first point I want to describe to you is my meetings with Yu Zhengsheng in 2009. I met at the arrangement of Chun Anjia, the man I just described to you. He set up meetings for me with Yu Zhengsheng in 2009, 2010, and even in 2011. Yu Zhengsheng was the most important person in Shanghai, which, as I said, was, if not the largest province, one of them. He was the party secretary of all of Shanghai, an extremely charming man. At our meetings, this is what happened. Our meetings always followed the same pattern. He'd start by reminding me that his team had scoured the world and they looked everywhere in every Western company for a bank that knows how to finance technology companies. And no matter how many times they looked, they always ended up with us. Your bank, Ken, is the best bank in the world for financing technology. And at that point, I wasn't aware that he was just smearing it on thick, because I agreed with him. We were actually, if for no other reason than we were practically the only bank in the world that financed technology to the extent that we did. So yeah, that sounded good. It made me feel good. I was glad he recognized it. I felt I was on the path to getting a license, but it got weirder as the year went by. By the second meeting, one of the most memorable things he said was, "Your bank, Ken, you may not realize this, but your bank is even more important than Morgan Stanley. And at that point, it began to dawn on me that I was being played because, first of all, Morgan Stanley's not even a bank, it's an investment bank, as you know. And secondly, there's no way on earth that we would be anywhere near as well known as Morgan Stanley. Morgan Stanley is a household name to anybody who's had an education or is involved in business in any way. Very few people knew our bank's name. We were important, but more or less hidden from view. At another meeting later in 2009, he took it one step further. He told me that my bank was even more important than Goldman Sachs. Can you imagine that? I hung on to that one because I know people at Goldman Sachs and I love mentioning it to them. But the worst or the best, depending on your perspective, was one of the last meetings I had with him in 2009. And at that meeting, Yu Zhengsheng ended the meeting by saying, he put his hand on my shoulder. Chinese don't touch each other that often either. And he said, Ken, you're, I believe, the smartest American I've ever met. Well, I think I probably know what you're thinking, that I'm naive and egotistical, but really not so much. If you knew me better, I don't think you'd think that, but it felt good. And I felt I was on the path. The second point on the arc that I want to describe to you was the day we got our banking license. My wife and I moved to China at the end of 2010 as I retired from being CEO. And the board sent me because nobody else wanted to go. Truth be told, everybody had some good reason. My kids are in school. My spouse has a good job. We just can't go at this point in our lives. So I went. My wife was enthusiastic. It was pretty good, I thought. She signed up for 4 years of art and culture explorations, and I worked on the bank. A year into it, it took a whole year of further hard work. This is one of those situations where I chased the license until it caught me. Meaning it was going to come no matter what I did, but I didn't realize it. And I felt I had to run fast and run hard. I ran hard that first year. At the end of the year, a delegation from the from the Shanghai municipal government came to me and they told me it was the happiest day of their lives. Every time they did something that was tantamount to screwing my project, that was the happiest day of their lives. And it was the happiest day because this is a day on which they could give me the banking license. And here it was. It took me less than 2 weeks to find out that this banking license that they awarded me was bogus. For two different reasons. Number one, unlike any other country where we've set up banking operations, one license does not suffice. Any other country, you get a commercial banking license, which are hard to get, and you're entitled to do what other commercial banks do for the most part. In China, this banking license only entitled us to call ourselves a bank, but it didn't entitle us to do anything. Even to set up a website, we needed a website opening license. To open a checking account for a corporate customer, we needed a checking account opening license. To open a savings account, we needed a savings account opening license. I won't read the whole list to you, but we would need about 25 different licenses to operate. And we only got a license to call ourselves a bank, and they wouldn't even let me call the bank what I wanted to call it, which was the Bank for Innovation, because they were reserving that for some reason for something in the future. The other thing that I learned when we got that license within a week or two was that there was some mysterious law on the books in China. It had been there for maybe 20, maybe 25 years. Of course, they were incapable of altering it because it was cast in concrete, which of course is the ultimate BS because there are no real laws in China. The Chinese Communist Party creates laws as they go, sometimes to punish people retrospectively for things that they don't like. So it's not quite like Congress. These laws are whenever they want them and however they want them. So once again, I was being had, but the law that they were referring to said that any new bank in China with any foreign ownership, and this was a joint venture, 50-50. And of course, we had no choice. You can't set up a bank in China unless it's a joint venture with a Chinese bank. They let us think that we had negotiated brilliantly because the law says the maximum that the foreigner can own is 20%, and we negotiated 50%. I took it as a sign that we'd done an extraordinarily good job of negotiating, or that they really needed us. But in time, I learned that it didn't make any difference what percentage we owned. They rule China. And if your bank is in China, they're in charge. In any case, the law, to get to the point, was any new bank with any foreign ownership cannot use Chinese currency for 3 years, which meant we couldn't do any business because the would-be clients only use Chinese currency. They don't use currency of other countries. And if they ever want to buy something from another country, they have to go to a government agency, pay in Chinese currency, and the government agency will take it from there because they control all of the foreign currency. And so we couldn't do anything for 3 years, but we still had to pay our employees. And there were 62 employees required by the Chinese banking regulators. But not to worry. They liked us so much they would give us a small subsidies to lessen our losses. And over and beyond that, because we were now one of them, we could do what Chinese people do. They help each other. And they strongly encourage us to teach other banks how our business model works, which we pretended to do, but we never really did. That's the second point. The third point, and I'm done with the ARC, and then I'm going to do two more things. I'm going to tell you why these things happen, and I'll tell you what my opinion of investing in Chinese stock. But I think you could already guess. The third point on the ARC was 3 years later when we got permission to use Chinese currency. Another one of those happiest days of their lives. They arrived, the delegation from the municipal government of Shanghai, and they said, here you go. You can now start using Chinese currency. And almost in the same breath, they said, one more thing. We admire your business model so much that we've decided to start a bank of our own here in Shanghai using your business model. And would you please spend time with the management team, helping them to understand some aspects of your business model that they still don't quite understand. When I said, why do you need a bank of your own? You've already got one. You own 50% of us. And you, in the end, because we're in China, have the right to rule us as you wish. They just laughed. And they said, no, 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 you don't understand. We want one of our own. So those are my 3 points describing our ARC. We stayed in China until actually we stayed in China until 2023 when Silicon Valley Bank globally disappeared. We meaning my bank, not my wife and I. And we never really made much progress. And then when the bank disappeared in 2023. The regulators came in. They took the bank, they disassembled it because it consisted of many parts. They put all the parts on the auction block. Almost all the parts sold immediately. Some took a couple of months because they're more complicated. But by the end of the auction process, there was only one entity left on the auction block, and that was our 50% ownership in the Chinese joint venture. Nobody would buy it. If only we had sold it 10 years before, we would have had an amazing return, because so many banks wanted a bank in China. But by then, by 2023, the relationships between the US and China were so bad that nobody would bid on it. You could have bought it for probably $10,000, and it would have been worth billions had it been sold 10 years before or 8 years before. So now to my contention that every Western company that goes to China experiences something similar, not identical, but similar. And the most obvious and probably in some ways egregious example are the automakers. I hope you're not heavily invested in General Motors or in Ford, because I believe that the American automakers will be history within about a decade. What happened there was very similar. They were enticed to coming to China in the 1980s because China didn't have an automobile industry and they wanted one. So they did everything they could do to encourage General Motors, Ford, and to a certain extent Chrysler to come to China and set up operations. And then they tied them up with regulations. And there are numerous approaches to tying up a company with regulations. One of them is that you require technology transfer. You have a joint venture partner, you're required to share your technology with a joint venture partner. Another would be indigenous or local content. 80% of your parts have to be produced in China. So you end up setting up a supplier network, just like you had in the US. Ultimately, you've transferred all of your technology to the suppliers. At some point, the suppliers get together. They're all directed by the government, and they form new entities who in the end will compete against you. Now, I'm not saying that the Chinese aren't smart or don't do something in addition to borrowing technology without paying for it. They add to it because they're very diligent, very hardworking, and very well-educated, very intelligent. So they took the technology that was extracted from the automakers and they built, ultimately, in the fullness of time, even better automobiles. You may or may not be aware that China now produces more EVs than all the other countries combined, and they sell them for very little money. So you can buy an EV for $25,000 that's made in China that will be better than the Tesla you just paid $80,000 for. I don't think that American automakers will be able to keep up. And I come from a General Motors family. So it would have been heartbreaking, but I don't want that to trouble me. So now, why does this happen? Well, let's talk about three things quickly. I still am on time, am I not? Yeah. The three things, the three reasons or sets of reasons why this has happened are four sets. Let me start with the beginning. When Mao died, well, first of all, when Mao came to power in 1949, he systematically nationalized all business activities. So private enterprise disappeared. Nobody was allowed to be involved in private. For the most part, those state-owned companies did not do well. He also nationalized the entire agricultural sector, which was a disaster. Finally, Mao died in 1976. And then after 3 years or so of different people jockeying for position, the person who rose up to lead China was Deng Xiaoping, which I'm sure everybody's heard of Deng Xiaoping. He was less intent on ideology and more intent on practicality. He's the guy who said, I don't care if a cat is black or white, as long as it catches mice. He's also the guy that said, let's hide our brilliance, bide our time. Because to the extent that China accomplished anything that was worthy of admiration, Deng Xiaoping wanted to make sure that we in the West didn't realize it, so that China could catch up without anybody noticing and wouldn't consider it a threat. So he and his group are the ones who invented the game plan I just described to you. If we need something here in China, let's identify some company in some country that has possession of that technology or that knowledge. Let's invite them to visit. Let's shower them with flattery and with promises. Let's red carpet their way into China. Once they're here, let's tie them up with capricious and arbitrary regulation. Let's extract their technology from them, either with regulations or when they're not looking. And then let's build competitors. And those competitors will ultimately have the home court advantage, and they'll beat those foreign companies here in China. And then when the foreign companies give up and go home, we'll send those companies overseas and beat them globally as well. There are so many examples of that. That is part of how this all happened. Now, there are other aspects to it too that I'll mention. A lot of it is our own fault, meaning we here in the US. If we want to right the ship, are going to have to look ourselves in the mirror and realize that there's a lot of stuff that we haven't done well. First of all, I think that we are overly confident. The average CEO in the last 40 years, when confronted with the prospect of taking the company to China, either thinks it's a shoo-in and it's going to make a lot of money, or thinks, yes, I've heard stories that it doesn't always go well, but hey, I'm CEO. I'm smarter. I'll crack the code. Our CEO group of CEOs in the US is definitely not short on self-confidence. And they definitely, as a group, have the attitude that other people may not be able to figure it out, but I am smart and I will crack the code. Let me add to it a couple of things. People in my age bracket, and some of you here are, maybe remember the book Getting to Yes, because almost everybody in my age bracket in the US that was in business got sent to a seminar on Getting to Yes. And Getting to Yes, which was a product of something called the Harvard Negotiation Project. Yeah, and so you know the book. And the book basically says, if I have a counterparty, you're my counterparty, it's incumbent on both of us to understand each other's needs and craft a deal that satisfies you and me both so that it will endure. I can tell you the Chinese Communist Party does not read that book. And before I left for China, I was trying to inform myself as best I could. And among other things, I read a book by a very famous, then anyway, sinologist at MIT named Lucian Pye. Lucian Pye published a book in 1982. It's only 100 pages long. It's called Chinese Commercial Negotiations. His book basically says negotiation in China is a form of war. And you can expect your negotiation counterpart to do anything and everything to win. And this isn't win-win, or if it's win-win, it means China wins twice and you lose twice. They will resort to misrepresentation. They will resort to intimidation. They will resort to out and out lying. But their goal is to get the biggest part of the pie and to leave you with either no pie at all or the smallest part of the pie. So be on guard. When I read that book, because I was brought up by very liberal parents who were very much involved with things like the NAACP in Flint, Michigan. And we were taught as children not to think that way. But it turns out when we got to China, within a year or so, I had experienced everything in the negotiations in which I took part that Lucian Pye had described in that book. And I remember reading the book before we got there and thinking, how could anybody be such a jaded scoundrel as Lucian Pye? And within a year, I was saying, the guy really knew what he was doing. That book is a good book. Getting to Yes was a good book, but it's not going to help me here. So the other thing that I would mention, I'm going to just mention a few things randomly and then round up here. One day, my assistant in China, for 4 years, I had a very nice assistant, a really good assistant, I thought. Her name was her American name. People always assume American names when they do business with you, or almost always. Her name was Vicky. One day she got really annoyed with me and she looked at me and she said, Ken, you are never going to be successful here in China. And of course, I said, what do you mean? And she says, it's your personality. You say what you mean and you mean what you say. We don't do that here in China. But she thought I was constantly being fooled. So I did something that I'd recommend to anybody who's interested in doing business in China, even our president. And that is, everywhere I went, I took 2 translators. One of them was to translate for me, and the other one was to take notes. And after the meeting, we'd all 3 sit together, and based on the notes, they would tell me what the people I was talking to had really meant, because they really don't always say what they mean, and they definitely don't mean what they say. And by the way, I want to make clear, I'm not castigating all Chinese people. In my discussion here or talk, I'm talking about the Chinese Communist Party. I'm not talking about Chinese as a group. There are 1.4 billion people living in China. It's about the size of the US geographically. 1 out of 14 is a member of the party. And they tend to control things. And by the way, Western companies, as well as so-called private companies in China, meaning private companies that were created, built, and run by indigenous Chinese, they all have what's called a party committee. The party committee is set up by the party. It may be secret. Often people don't know about their party committee. The party committee makes decisions even for the private companies. And because they're anonymous often, they communicate those decisions and execute on them through members of the board. So yeah, we too had a party committee. We didn't know who was on it. Half the board was Chinese, half of it was American, and the party committee operated through the half of the board that was Chinese. They also have the privilege of taking what they call golden shares in any company, be it private or state-owned. Well, in the case of state-owned companies, they already own it. But in the case of the private companies, they are enabled to take so-called golden shares, which give them further influence and a nice share of the profits for the party or for individuals in the party. Finally, I guess I should say that even if we as Americans did a better job of preparing ourselves and arming ourselves, by arming, I don't mean with guns, I mean with appropriate negotiation techniques. And even if the Chinese Communist Party didn't have all the inherent advantages that they have, it still, our bank would never would have worked in China. And I didn't realize that before we went. I learned that in the fullness of time. And the main reason I think, there are two main reasons why I think it doesn't work, wouldn't work. One of them was that unlike the US, the government has a lot to say in who banks with whom and who's going to flourish and who's going to wither. So for example, in Shanghai, there was a group in the finance department of the city that kept track of all of the startups and decided themselves who is going to survive and who is probably not going to. So it's not 100% control. It's more along the lines of, we like your startup. We're going to provide it with distinct advantages, politically and financially, and we don't like your startup. So you can wither on the vine. And I thought we were competing for customers, but it turned out we weren't. Because that group had a lot to say in terms of who banks with whom. Were you both in Shanghai, that group might have said, you're going to bank with Silicon Valley Bank, and you're going to bank with who knows what. So the two systems are inherently incompatible. And the other way in which the two systems are inherently incompatible, and this applies primarily to banking, not to other industries, is this. In the US, when I started my banking career in 1983, there were 18,000 banks. Today, we're somewhere in the 5,000, 6,000 range. What happened to all those banks? Well, some of them got acquired because big banks acquire little banks. Some of them, many of them, were closed by the Federal Reserve or the controller of the currency or one of the other various regulators because they didn't do well. Why didn't they do well? They made bad loans. And banks in the US understand if they make too many bad loans, they're going to get in trouble, not just with their shareholders, but also with the regulators, and they become candidates for being closed and taken apart, and the constituent parts would be auctioned off. In China, it doesn't work that way. And all the banks in China are owned by the state. They never close a bank. when a bank gets itself into trouble, usually only the regulators know. It's not written up in the newspaper. The public doesn't know unless there's a rumor that's spreading. The regulators come in late at night, they arrest the CEO and maybe a couple of other people and put them in prison. And then the next thing I'm going to say is meant as a metaphor, so please don't take it quite literally. But they kind of arrive in the middle of the night with a big dump truck and take all the bad loans and put them in the dump truck and drive them out to a landfill and bury them. That's a metaphor. And then they recapitalize the bank without anybody knowing it except the bankers themselves, with money from fundamentally from Chinese taxpayers. And they reopen and nobody's the wiser. So it's a different system. What that means is Chinese bankers can take a lot more risks than US bankers can. In the US, one of the things that made us dominant was we specialized so that we all in the bank understood how to do this without losing money, which is, it's not because we're brilliant. You can teach our methods to a 12-year-old. So 12-year-old was paying attention, but it was a specific way of doing it. And nobody else wanted to invest the time and energy in doing what we did. So they just didn't. And the result was we had almost no competitors. Every once in a while, some banker at another bank would see what we were doing and say, that looks so interesting. And they'd go to their own management team and say, can we try that? And they might get special permission. But within a year or two, they would have lost money because they didn't really understand the methodology. And once they lost money, their bosses would say, this was stupid. We never should have done it. And they all stopped to it. But in China, everybody was copying our method. They didn't even understand how we did it. And they were all copying it. And if they lost money, it wasn't that big a deal because they weren't going to get in trouble. And their bank was not going to be closed. So now I want to see where we are. I've got to be done in 4 minutes. In 4 minutes, I will tell you why I think, well, you do what you want, but why I wouldn't, if I were you, invest money in Chinese stocks. And by the way, I did it myself for years with no great success. I have 4 reasons for it. Number one is the stock market in China works differently than the stock market in the US. In the US, it's sufficient to study companies and probably economics to enable you to do a decent job of picking stocks. In China, you have to do that. But in addition to that, you have to understand the party. What's the party's intention? What is it likely to do? Because the party can move individual stocks up or down, and it can move markets up or down. And I think understanding the party is hard because it's secretive. So you don't really know what the party's up to. And if the people that you've picked to be portfolio managers have the time and energy and the knowledge to follow the party, maybe they can do well, but I'm skeptical. That's number one. Number two is the Chinese economy works like this. In some sense, it's in a weird way, it's almost capitalistic. And what I mean by that is each one of the municipalities has a party secretary, and that's the top dog. The party secretary is incentivized to do as much as they can to build the economy. And that's what the basis on which they are judged. And every 2 or 3 or 4 years, they get moved around. They get either upgraded to a better city or downgraded to a lesser city. So the result is, how many automakers did we have when I was growing up in the US? 3. I think, maybe 4 if you count American. Today, I don't know how many automakers we have in the US, but it's certainly not more than 25. And most of them you don't probably know anyway because they're small, experimental. So there aren't that many. In China, we already have at least 200 automakers because every municipality, every party boss in every municipality wants to have an automaker. It's a massive competition. An awful lot of them can't survive. They just can't survive. That's way too many automakers. Which brings me to my third point. How is it that China is able to sell EVs that are better than Teslas at 1/3 the price of a Tesla? It's because they're not focused on profits. They're focused on strategy. Wall Street is focused on profits, not on strategy. But Chinese companies are focused on strategy, not on profits. And what do I mean by strategy? The ultimate goal of the Chinese Communist Party is twofold, maybe threefold if you're generous. The primary goal of the Chinese Communist Party is to maintain its own power. Its secondary goal is to eclipse the US as the #1 power in the world. And the tertiary goal is to keep the Chinese people happy so they don't revolt. So that's a third reason. But they're constantly squeezing the costs, in order to compete fundamentally against the West. So too many companies, too much government involvement, constantly squeezing the price, which is a strategic issue. And fourth, you should also know that any company in China that is in possession of technology that is useful has a legal obligation to sell it to share it, with the PLA, People's Liberation Army. Meaning, when you invest in China, you are indirectly investing in the PLA. And I think personally that we should avoid investing in the PLA because the military analysts in the US say that the PLA has gotten better and better and better and is now at a point where they're skeptical that in a war with us, we could win. And so that's my view. I may not be a candidate for Wall Street, but I do feel that I want us to come out, not necessarily on top. I have no desire to keep us #1. I just don't want China to be #1 because I wouldn't enjoy living in which China dominated. That's my opinion. It may not, from your point of view, have that much to do with your activities, but I do feel compelled to share that with you. And finally, my closing remark will be, because people used to, of course, we've been back from China for a while now, but they used to ask us, what was it like? Did you enjoy it? And they weren't looking for a lecture. They were looking for a one-sentence answer. And we always answered the same way, and we stick to it. The years in China were the most interesting years of our lives. But I would never enter into a joint venture with the Chinese Communist Party again, if I could help it. So that's my story. I think I've used up all my time, and now you can't ask questions.
No, no.
Any questions?
Thank you so much. That's very interesting. So there are supposed successes like Apple,
Uh-huh.
and because Foxconn, which does all the manufacturing, is a Taiwanese company, does that make it safer or whatever? And then of course we have Musk, which built his biggest factory in, I think it's in Shanghai. There is that going to come to bite him later on?
Well, if it doesn't bite him, it's going to bite us. And what I mean by that is, I don't know if you had the chance to read the big book that Patrick McGee brought out at the beginning of 2026 called Apple in China. It's, if you haven't read it, you might really enjoy it. It's extremely well researched. Patrick McGee is a young man in his 40s who has worked as a journalist of significant newspapers, including the Wall Street Journal and the Financial. And he published this book at the beginning of the year. I think it's a credible book. It's based on an immense amount of research. He says that nobody has helped Xi Jinping more than Tim Cook. Because under Tim Cook, Apple spent $50 billion a year training Chinese engineers, most of whom don't work for Apple anymore. They worked for Apple for a very short period of time. And now they work at competitors, Xiaomi and Huawei and other competitors. So Apple's doing well, for sure. I don't know that it necessarily will forever. And I certainly don't think that their experience in China is going to lessen their profitability. But I do think that Apple has inadvertently helped to strengthen a country that wants to dominate. And I personally don't think that's a good thing.
Trustee Hill.
Oh, I'm just gonna have a fun question for James Callahan. How much money we have in China now? But just a joke. You don't have to answer. But the question for you is, did you think that American CEOs of Chinese origin, understanding the culture, did a little bit better, or didn't matter?
Well, I'll do my best to answer that question. And I want to be as careful as I can, because I don't mean to impugn people. The first problem we have is, well, think about this. We have between 250,000 and 300,000 Chinese students at American universities. We have fewer than 1,500, 1,500 American students at Chinese universities. I think that in and of itself is troublesome, because they know more about us than we know about them. And I don't think that's good. I think it's better if we know as much about them as they know about us. That's number one. Number two, the vast majority of those 250 or 300,000 students at American universities are just fine people and are not going to do anything wrong. However, there will be instances where technology is borrowed, taken back to China and shared. And we could say, well, that's horrible. We want to put an end to that. But first of all, in the grand scheme of things, I think we gain more by having Chinese students in our universities than we lose through so-called industrial espionage. So I still think we should just keep doing it. And if we're going to prosecute, we should be really careful to make sure we've got to have a better trained FBI than I think we have. We got to spend more money on that kind of thing, because to the extent that we miscalculate and we end up accusing people that aren't guilty, it casts a shadow over everything. And other Chinese people say, God, maybe we shouldn't send our kids to China, to the US anymore, because they're out to get us. So it's a very complicated set of issues. The other aspect of it is that China has, the Chinese Communist Party has an organization which you're probably familiar with, called the United Front. The purpose of the United Front is to send Chinese to other countries in order to wield influence. And you may recall there's a instance that was just in the newspapers the other day. There's a city here in California with a mayor who was just indicted for being fundamentally an agent. And that's obviously not a good thing. But I also think that closing our borders is a bad idea. For two reasons. One of them is my own personal philosophy that we should be open to others and that we gain by having people from other cultures. That's a belief of mine, which not everybody shares. But over and beyond that, if we're going to compete against China economically, we have to have more PhDs in the STEM sciences. And we don't. Americans want to go into, they want to go to HBS and study finance. They don't want to go in general. We're not going to be able to keep up scientifically and technologically if we don't have people from other countries, particularly India and China. And I do think that if we had better educated FBI and that we could deal with it without ruining it, so to speak. So I don't know if I answered your question.
Yes, thank you. That was more about like real American CEOs, but they are Chinese, so they understand. Because you alluded in your speech that
Yeah.
the lack of understanding, and those of Chinese origin or they have the Chinese culture, understand better and fare better dealing with China.
Yeah, yeah. I think that China is different enough from the US that if somebody comes here when they're 19, that it's an adjustment. And it may be a lifelong adjustment because they're used to a different system. Anyway, anything else?
No, well, thank you very much. That was
Thank you.
interesting. Thank you.
I appreciate your listening. I hope you don't think that I'm too negative.
Not at all.
Thank you.
Thank you. We're going to take a break for lunch until 1 o'clock.
1:11.
1:11.
Yes.
1:11. this afternoon with a session on dollar hedging for foreign investment with Adam Berger and Molly Conway Scabello. I got that right, from Wellington. Thank you for joining us.
Thanks everyone for having us. I'm Molly Conway Scavello, and I'm based here in San Francisco for Wellington. I cover the West Coast, and I've had the pleasure of working with your organization for the last 5 years. And so I just want to start off by saying a big thank you. Today, we serve in your portfolio in Core Plus fixed income, and we've enjoyed this partnership for the last 24 years. We really appreciate it. But as a $1.3 trillion asset manager, managing assets across almost every corner of public markets, we do really value these opportunities to come to your institution and share more on our perspective on markets. And I think there's no one better suited for today's conversation than Adam Berger, who's a partner at Wellington. He's based in our Boston office. He is the head of our multi-asset strategy team. And his role at Wellington is really to look at portfolios from the seat of our clients and to try to tackle some of the most pressing investment policy and governance issues that you may face in your seats. And so, today we'll be talking about currency in client portfolios. It's definitely a topic that has been coming up with more frequency, certainly given the shift in the US dollar and how clients are now thinking about this as a material risk in their portfolios, but it's really a unique risk and one that can be managed in many different ways. So Adam has some slides that he has organized today. He's well equipped to walk through those, but we really want to make sure that this session is educational and beneficial for all of you. So please interrupt Adam with questions along the way. We want to make sure that this is helpful for all of you. So Adam is joining us remotely, and he will be sharing his screens or his slides on screen. And so with that, I'm hopeful that I can hand it to Adam virtually. So over to you, Adam.
Thanks, Molly. And let me know if this hopefully will come through momentarily and you'll see my slides. The one thing to bear in mind is I can't really see the room. So I will try to pause periodically, or I don't know, Molly, if you want to just step back to the podium and wave your arms around if there's a question, because I'm delighted to stop along the way and make this as conversational as we can, given the geographical constraints. And sorry that I'm not out there in the Bay Area with you. I always love being out there, but I was not able to travel this week. So the topic of dollar hedging for investment. Let me give a quick overview of where I'm going to go, and then I'll walk through a number of the questions, concerns, and issues that arise with thinking about currency hedging. Anytime you invest in a non-US asset, you are bringing currency risk alongside the risk of that asset itself. There are multiple ways to manage currency exposure that I will touch on. And I think for any organization, I talked about key factors. What I'm really talking about is the key factor in figuring out whether and then how to manage that currency exposure include the magnitude of the currency risk. And I would say that's both in absolute terms, how much it matters for your overall portfolio, but also how much it matters relative to the underlying risk of the assets itself. I'll illustrate that in a second. The nature of home currency is very important. So the work that I'm sharing today is work that we talk about with clients around the world. And depending on the home country you're starting at, as I'll get to in a minute, that has a big impact on the hedging decision. Your own organizational priorities, capabilities, resources are important. And as I'll get to in 1 second, the expected return on currency is important as well, where you have a view. We typically come at this with the idea that for most currencies, there is not a long-term expected return, positive or negative in either direction. So unlike most assets that we might purchase in a portfolio. On the whole, currencies will go up and down over time, but our base case, with the exception of possibly emerging market currencies I'll come to, is that you shouldn't expect over the very, very long term any meaningful return from currency in either direction. Things tend to normalize when they move out of bounds. So as I said in the opening, when you invest in anything outside the US, you are getting the risk of that investment and you are getting the risk of the currency of that investment relative to the US dollar. And important to remember, the direction of the currency matters a great deal. The real risk as US dollar investors that you're worried about is actually the US dollar getting stronger, because in that case, the returns of that asset, when you bring them back into dollars, would be lower. If the foreign currency that you're holding depreciates over time because the US is strengthening, that's a problem. If the dollar is weakening, that is a source of volatility in the portfolio, but the returns are actually positive. You're then actually reaping the benefit of when you eventually repatriate those gains back into US dollars, you're actually doing better than you were at the time you made the investment. And as I alluded to, the impact of currency, we use the FX, foreign exchange abbreviation on these two charts, relative to the underlying asset volatility varies widely between stocks, equities on the left, and bonds, fixed income on the right. And what we're showing, again, each of the columns here represents each of these asset classes in a different global currency. For the purpose of MSERA, you can really just focus on the USD because that's our home currency. And you see that in equities, for non-US equities, the dollar does contribute a little bit of risk, but it is far overshadowed by the underlying asset risk. So that most of the risk you're getting from non-US equities is the equity risk and not the currency risk. By contrast, in bonds, which tend to be a more stable asset over time, it's much closer to an even split. And if anything, actually, there's probably a slight edge to the dollar historically in terms of how much of the variance or volatility is coming from currency risk as opposed to the underlying risk of the bonds that you're holding in another currency. Given this framework, our general guidance, because we do think that when you're investing in foreign bonds, you're really investing them for the asset class and not for the currency. Our general belief is that you do want to hedge currency in foreign fixed income portfolios because you want to take that dollar risk out. The one exception I alluded to would be emerging market local debt. Typically in those, so emerging market countries can issue bonds in foreign currencies and in developed market currencies like a dollar or a euro, even if they're an EM sovereign issuer, or they can issue in their home currency. The home currency debt, the local debt, we think part of the return from that the return from that asset class is from owning the EM currency. So we would not typically hedge that. Also, hedging EM currencies can be expensive. In our experience, most U.S. investors do not hedge currency in their non-U.S. equity portfolios. They look at the chart on the left and say it's just not worth the hassle of trying to hedge that return. Again, especially if we think over the long term, there really isn't a positive or negative cost to it. Most of the risk we're taking on is the equity risk that we want. Having said that, there are definitely arguments to hedge some or all of the currency risk, even in equities, and I'll get to that in a minute. I'll pause for a second just in case there's a question.
No questions at this time.
Great. So when we think about the currency, we tend to map currencies to one of four categories. And here I'm talking about the home currency that we're starting with. So for us, it's the US dollar. Some currencies are dampening, meaning that they tend to move in line with foreign equities. The US dollar is an amplifying currency, meaning it's a little bit of a safe haven. So that what happens in periods of market uncertainty is you would typically see risky assets like equities fall at the same time the foreign currency falls. So you get the worst of both worlds, that the currency amplifies the downward move in markets. We also have at least some still, we used to have more managed currencies where the policymakers in that country are really trying to control or limit the range of values that you get. And then there what we classify as noisy currencies that don't really fit neatly into any of these buckets. This is just a illustration of sort of where different currencies map. For us, the dollar and the yen are the two real safe haven amplifying currencies based on the data that we've looked at. As I sort of alluded to, the nature of the currency does typically have some implication for how you think about investment policy or hedging policy with respect to that currency. So in other words, because these amplifying currencies have a negative correlation, because they amplify volatility in foreign markets, if we hedge them, that actually decreases the volatility of the overall portfolio. If you're a Canadian investor or an Australian investor, if your local currency is automatically dampening, you actually, by hedging it, you sort of take away that benefit. But the US dollar doesn't have that benefit. If anything, it can sort of amplify moves. So the argument, the reason we would begin the conversation about considering hedging in the US is because of that amplifying characteristic and the idea that putting some hedge in place can help mitigate downside in a market sell-off. So to the extent we are thinking about hedging, they're essentially, again, it's a bit complex, but there's sort of a menu of options in terms of how to approach hedging. So fully unhedged basically leaves all the currency exposure in any given portfolio unhedged. Asset class based, which I already sort of opened the door to, you really would think about the hedging decision based on the asset class. So you might say in asset classes where the currency risk runs the risk of dominating the asset risk, I don't want that extra risk in my portfolio, and I'll think about hedging that. In other asset classes where currency doesn't really make a meaningful contribution to the overall risk picture, I'm gonna leave currency unhedged and not bother with hedging it. On the flip side, going on further, you can fully hedge the portfolio to basically take all currency risk everywhere out of it. And then a few other ideas here would be what we talk about. An optimal hedge ratio is thinking about hedging enough equity to minimize the volatility of the portfolio. So for many people, if you do sort of an optimization on the pros and cons or the cost benefit of equity hedging, you might not hedge all of your equity. You might hedge, say, 50%. Historically, for many people, has sort of looked like a good number, where it brings down the volatility enough that it really doesn't contribute in a meaningful way. Sometimes that hedging the full amount can actually leave you with more volatility.
Adam, quick question.
Yes, sure.
As you're talking about hedging, I don't have much experience in that space, but can you just give us some frame of reference as to what it costs to hedge?
Yes. So
or how that affects the performance?
Oh, that's actually, so that's, I'm going to get the next point. Premia harvesting is explicitly thinking about the cost of hedging and factoring that in. It really, it's very hard to make generalizations because markets are very dynamic. Currency markets are as dynamic as any other asset class. And so at times, the cost of hedging can vary widely through time and will also vary widely across currencies. They're really, it's hard to sort of put a dollar estimate or a percent estimate on the cost. If you think about, again, from a long run perspective, you can make an argument that there shouldn't be a meaningful cost in hedging in aggregate. But one thing that people do is think about is basically not hedging positive carry currency. So basically, if you think about the interest rate differential between your currency and the currency you're hedging, you're really trying to only hedge currencies where you're essentially hedging for free, so to speak. It's that there's a cost, but the interest rate differential sort of makes up for that. And then the last approach is actually to seek return in currency markets using active management of your currency exposure. So here you would typically be, a few organizations might do this internally, but you would typically look to a manager who has views over time on the relative attractiveness of different currencies and is actually going to try to build a portfolio with a positive return expectation based on how currencies are likely to move in the near term. So here you're less focused on hedging per se, and you're more focused on currency as a potential source of return. I will say in this case, many people, you could do this from any starting point. I think for many people, they would look to the manager to first off sort of neutralize the currency exposure and then lean into places where they see foreign currencies being attractive. So you'd keep that exposure on. You might even amplify it. So you might end up with more exposure, again, depending on how you structure the program. If you have 10% of your portfolio is in euro denominated assets, you might even have 20% euro exposure if the manager likes that currency. There's no right or wrong answer here in terms of which approach makes sense. What we tried to do to help people think through the options is create this little schematic, which is actually three-dimensional. So the x-axis here, the operational complexity, if you're doing active management or if you're trying to harvest the premia, because these markets are dynamic, that's going to require operational complexity in terms of what you are adjusting, how many positions you're going to have on. There also, you see it's colored in red because it's also high frequency. You're likely to be changing the nature of your hedging portfolio and the positions in that portfolio over time. On the y-axis is investment complexity. And again, that's also a more complex approach because the investment decision about where to be, active management is the most complex. You're really trying to make a call in the direction of markets. Premia harvesting is a little bit more binary. You can sort of get a sense of whether you're getting paid or whether you're paying to hedge this currency exposure. On the bottom row, the bottom left-hand side here, you see fully unhedging the portfolio, which is obvious. It's very low operational complexity. You don't have to do anything. It has a little bit of investment complexity because as you try to interpret your results over time, your returns from any one asset class are going to be a mix of the underlying return to that asset and the currency return. The flip side here, if you fully hedge, again, we think of this as sort of a structural decision. It's a little more operationally complex because you are having to look to either internally or externally look to someone to put these hedging positions on and to manage them through time. But it's a pretty static and stable approach. You're not changing what you do. You're basically you're at any given moment in time looking at understanding your currency exposure and then hedging it. And then the optimal hedge ratio asset class based are sort of in the middle in terms of complexity, both from an investment perspective and an operational perspective. One more note here. This is a space where you can look, again, depending on the nature of your managers and the strategies that you're in, you may be able to look to your managers to do this on your behalf. So that if you decide, for example, that you do want to hedge currency exposure in global fixed income, it's likely very easy to ask your fixed income manager or your global fixed income manager to hedge this on your behalf. And again, that's not an unusual request by any means. In equity space, the same is true, but I would say, I think on the whole, if I had to generalize, fixed income managers, it just tends to be more part and parcel of what they're doing for clients. An equity specialist who's really focused on stock picking may be a little more reluctant to sort of put in a hedging program, but most managers, I think, do have the scale and the ability to do that. It's also important to think about the benchmark, right? Whatever you're doing with that asset class, when you're then looking to the manager's performance, you don't want to give them unless they're specifically a currency manager, you don't want to attribute any of their skill to what's happening on the currency side. If you're hedging your global fixed income, you want to give your manager a hedged global benchmark if you're asking them to do that on your behalf. Just for a little context on the hedging decision now, I think it is an interesting moment. Both of these charts, although looks like they're moving in opposite directions, it's because of the convention of how these currencies are quoted. But what you're seeing on this page, since the GFC, which is the shaded area in each chart, the dollar has strengthened pretty notably against both the euro and the yen. You see there's been plenty of noise around here. It's not a straight line path, but we're in a period of relative dollar strength. There is certainly no reason this can't continue, and happy to touch in Q&A on reasons why the dollar strength might continue. We've seen it, just with the global conflict recently. It's been relatively good for the dollar. However, if you think about the long term and some expectation of mean reversion, as a US dollar investor, you would have been great to be hedging over this period from 2010 to the present while the dollar is strengthening. If the dollar is going to give up any of these gains in the medium term, you'd be better off from a pure return perspective being unhedged rather than hedging. And that brings me to a question that sort of entered the currency discussion in lots of places over the last 6 to 12 months, which is this question about U.S. exceptionalism. Is the U.S. really a different country and in a different place compared to the rest of the world from an investability perspective? We know that for several decades now, the dollar has been the world's reserve currency, but the U.S. equity market, I would argue, has also been the envy of the world in terms of the companies that we have, the strength of our corporate governance, the commitment to returning capital to shareholders via share repurchase and dividends. It's been a very compelling place to invest. When we look forward, we spend a lot of time talking to clients about this idea of two truths of U.S. exceptionalism. That parts of U.S. exceptionalism, in our view, are very much intact. If you think about what's happening with artificial intelligence, where we remain the global leader, and that's an area we think is going to continue to have huge impact on the economy and the stock market. Our earnings growth remains strong. We have potentially attractive and growing companies even entering the market via IPOs later this year. On the flip side, the world's faith in the dollar is waning a little bit. We do not see it being replaced as the world's reserve currency anytime soon. I can touch on why, but there really is not, in our minds, a viable candidate for another global reserve currency. But you see in the rise of the price of gold, in some of the ways that our allies view us, talk about the U.S. as a reliable partner, some of our influence in the world seems to be waning. Some of that may be deliberate. We're making a decision not to intervene in global affairs in the same way. But some of it's also likely, just concern from other countries about the U.S.'s role as a stabilizing force in the world, and also to some extent about the U.S.'s level of debt. Our debt to GDP, went up notably during COVID, but continued to go up even in the post-COVID period. We are still running very high deficits, especially for a period where there's not a recession that we're fighting or some other emergency like a war. And our debt to GDP is quite high. So again, this page just puts in text some of the ideas I just shared earlier. But parts of U.S. exceptionalism are intact, but the parts that are weaker, does sort of run the risk that the idea that the U.S. will be or will always be a safe harbor currency, and that will have this amplifying characteristic that makes it, that at least opens the door to think about hedging U.S. dollar exposure. Some of that might be changing if the world's trust in the US is shifting. And I would say it's not just about the rest of the world. As you may recall from the last presidential campaign, the administration wasn't always crystal clear, or I should say, Donald Trump as a candidate was not always crystal clear on this topic, but there was definitely some campaign rhetoric around the idea that the rest of the world was keeping the dollar artificially high and creating a trade impediment, making the US less competitive from a trade perspective because of a strong dollar, and that a lower dollar might be welcome. There's been a little talk, I don't know how much it's made it out into your discussions about this idea of Mar-a-Lago Accords that would be based on the Plaza Accords of the 1980s, where the world leaders might come together and agree systematically to allow the dollar to weaken over time. And again, if we did have that type of a situation, that's a place where you'd actually be better off remaining unhedged as opposed to hedging. So for everything that I said in the first half, there's reason to think there could be a little bit of change at the margin. Just to recap, anytime as a US investor you own non-US dollar investments, and I didn't even talk about the diversification case. I'm happy to talk about that. We're big believers in global diversification. It does just bring this additional currency risk. And again, the real risk we're worried about is a rising US dollar. That's the piece that's going to cut into into the returns from our non-US holdings. We do think, given the risk profile I showed earlier, there's a compelling reason to hedge, for US investors to hedge most of their non-US fixed income risk. We don't see a lot of investors trying to do too much or be too creative in hedging their non-US equity risk, although it is an option, especially given the US's amplifying characteristics. In terms of the exact policy that you take on, there's a range of choices, and it really is a question about governance, how intensive you want to be, how much you want to specify, both really the operational investment complexity as I touched on. And then, anyone thinking about this today should think both about the recent course of the dollar in terms of strengthening over the last decade plus, and the risk that perhaps we're at a pivot in the dollar's behavior going forward.
Any questions from the board? We have a question. Go ahead.
Yeah. Adam, thank you for your thoughts and the analysis here. Just a quick question. Given our debt posture here in the United States, our sovereign debt, and also you can throw in the private sector debt, it's pretty emblematic of the West in general. But then you have other parts of the world like the global East and the global South that don't have the same debt posture as the West. How should we think about exposure to both sovereign and corporate debt in, say, for example, the global South or the global East, denominated in local currencies where those currencies and those economies don't have the debt posture and profile that we have here in the United States and in the West in general?
I think it's fair that you actually said probably more eloquently than I did earlier. I think you made the case for why investors hold emerging market local debt and don't hedge that. Because I think there is, I would say there's been a long-term argument that you earn a risk premium from holding emerging market currencies. The market doesn't always want, or at least historically has not wanted to hold Brazilian reals or Thai baht necessarily, that you get some extra return for bearing that currency risk. And as you alluded to, I think that's been true for decades. I think what's a little bit different today, as you alluded to, is the relative posture of US dollar versus these other currencies may actually be shifting, that the policies, both the fiscal policies in terms of debt and also monetary policy in terms of how quickly they are likely to react to inflation. I think there is a little bit of a pivot there where we might see that valuation gap narrow. That's going to be a good thing for those, for both the debt and the currency of those emerging countries. And it's a reason to include them in a portfolio and to not, and then you really don't want to hedge the currency because that's a part of the return story. Just to add one more thought, at the risk of running on a little bit, a colleague a couple of years ago, we do a project every few years at Wellington called Future Themes, where we sort of brainstorm a number of different ways the world could be changing over a 5, 10, 20-year period. One of the themes that one of my colleagues wrote about was the EMification of DM. The idea that we used to have such profound differences between emerging and developed economies in terms of governance, in terms of the rise of populism, in terms of willingness to tolerate inflation. A lot of those gaps feel like they're going away. And again, that may make emerging markets broadly appealing areas for investment over the medium to long term. Did that answer the question?
Quick follow, yes. And quick follow on, if you were in our position, should we begin thinking harder about that kind of exposure? And I'd also welcome the comments from our investment consultant about that as well.
So let me go first, and I'll let Callan chime in as well, by all means. I think the answer is yes, but time horizon is really important. I will say, we continue to be in a period where the U.S. market has done very well, and where the outlook for U.S. earnings has been and remains quite strong. I will say this is, when we manage multi-asset portfolios on behalf of clients, we do strategic asset allocation, and for many clients, we do tactical asset allocation. So that's positioning with really a 1-year horizon. And we have been overweight the U.S. on and off for an extended period of time. We have not been overweight emerging markets until 2026. So we just got more constructive on emerging markets. So I do think there is a case there. You just have to be thoughtful about, and I should say emerging markets are interesting as well because they do have an angle, many of them are levered to technology and the rise of artificial intelligence and demand for computing power. You have to be thoughtful about the time horizon, and emerging markets can be volatile. So I would go into them today prepared that they may not work right away. But I do think they're compelling over the medium to long term. And again, we like them in the short term as well at the moment, but that could be more volatile.
Thank you.
Currently, your exposure to emerging markets is predominantly or almost exclusively emerging market equities. You don't have any strategic allocations to emerging market debt. Your fixed income managers have some latitude in their guidelines to add EMD, but it's a small amount. It's limited, and the exposures that you look at historically would be minuscule, so to speak. One factor here that Adam didn't get into in a whole lot of detail is, when you look at the volatility of unhedged emerging market debt, it looks a little more like equity as opposed to fixed income, at least as you define fixed income in your portfolio. I was just looking, was pulling up a chart when that conversation was going on. And, if the volatility of the U.S. equity market or the global equity markets 20 years is about 16%, emerging market debt is about 11 or 12% on local currency, whereas fixed income is probably 4%. Just to put it into some perspective, it's like 3. So it's 3x the volatility of U.S. bonds. So it's just those are all factors to consider as part of a multi-asset portfolio. I don't pretend to have any sort of unique insights on the strength of the dollar, debt burdens, implications on currencies. I agree with Adam's statements about, our experience with clients, institutional clients, is that by and large, the equity portfolios are held unhedged. There is an active hedging going on. That's not to say that we don't have a few that do it. Usually coming at it from a volatility concern perspective, that it's if you agree with Adam's position that over time you're not going to get anything from a basket of currencies, it's a zero return proposition, but it adds risk. Some have expressed the desire to just hedge the risk out, which is complex and costs money, but it has the potential to reduce the volatility of the portfolio.
definitely also agree with the currency as part of a bond portfolio. It really overwhelms the risk return profile of a bond portfolio. And so most exposures you see to non-US bonds are hedged back with the exception of emerging market. Yeah. So yeah, I don't have any particular crystal ball that tells you, how that's all going to play out in terms of your questions about deficits and all that kind of stuff.
Thank you, Jim.
I think we have a couple more minutes. I'd love to hear from Adam just a little bit about what he's most, worried about in the balance of the year when you look at interest rates, inflation, foreign exchange, the dollar. I know this is something you specialized in, so we have a few extra minutes, I think. So I'd love to hear what you're worried about or what you're excited about. I know corporate earnings are growing at over 20% this year, and AI is pretty much in the United States and growing. So, what are your thoughts?
Thank you for the question. Happy to touch on that. I would say so. I will start by saying, as an investor, I have a tendency to worry probably more, and I have sort of a value bias and tend to think about mean reversion and the idea that trends don't go on forever. But I also try to have some self-awareness of that bias. And when I listen to my colleagues and the overall tone of the conversations at Wellington, we remain pretty optimistic. So there's plenty to worry about, and I promise to get to your worries. But just so you know, in general, our positioning is pretty risk on. I mentioned the fact that we like EM, we like the US, we like equities in general at the moment. We actually think duration's okay as well, but on a relative basis, if we have to choose between the two, we are actually modestly leaning into, or I'd say almost maybe more than modestly, moderately leaning into equity risk here. And the view is there are a lot of things that can go wrong. We see them in the headlines at the moment every single day. But I think the market is perhaps, or investors are perhaps underappreciating the strength of the underlying economy coming into this year, and as well as some mitigating factors that I think have the potential to take the edge off, even if there is some bad news to come. And that's both on the fiscal side, where we think the economic benefit of the fiscal package passed last July, is still making its way into the economy, certainly through Q2 and maybe even into the back half of the year. And you have a Federal Reserve that, although again, they may see their hands tied, but they could see their hands tied by inflation, I think is also really committed to trying to protect growth as well. And so we don't really see a lot of cracks at the moment, but if we did to see more cracks in the job market or in other places, the Fed does still perhaps have a little bit of leeway to cut further. They may have to eventually hike to take care of inflation, but I think they might fight if they have to fight a stagflation type backdrop, my view has been they're going to fight the stag before they fight deflation, which again, I think is still okay for markets. And as you alluded to, earnings growth has been really strong. We were very pleased with the way earnings came in Q1, and the outlook remains pretty favorable. So I'd say we are, perhaps at our peril, more excited than worried here. There is a saying that markets climb a wall of worry, and I think there's plenty to worry about, but we feel pretty good. The things that I worry about, you alluded to inflation. I think that's the big one. I think it's a bigger worry over the medium term as opposed to the near term. That could be wrong. The market could shift its focus or its expectations very quickly in the next 6 months. But I think that's probably more of a medium term worry for the economy. I think we are likely to see higher inflation in the next 3, 5, 10 years, certainly than we saw in the 2010s. But it doesn't necessarily have to be out of control. I don't think the Fed is going to shift its target from 2% to 3%. But if you think about the fact that we undershot 2 for so long, I think we might sustainably overshoot it for a bit. And while that's not great for the economy, or it may not be great for the way we feel about the economy or for valuations, it's not catastrophic, and it does allow us to work down our debt to GDP, which is the thing that I watch very closely. Geopolitics is always a risk. I think it feels heightened now, but I think we can see there's some recency bias there. I think geopolitics often feels uncertain. There are lots of things that challenge our views. So I pay a lot of attention to it, but I think it's really hard to position a portfolio for it. And then the other thing I'd say that's on my mind as a worry is the private credit space. We've certainly seen some headlines there around defaults. Last year, we've seen more liquidity concerns with individual investors trying to get money out of these semi-liquid funds that are maybe less liquid than they thought. Again, I don't see any of those. I don't see enough there to really make me worried. It just strikes me as an asset class where both investors and even PMs may be a little bit overconfident in how good things are. It's had an incredible run, but it's in my mind still a new asset class that came into being or came into its own after the global financial crisis, and as a result has really never been tested by a protracted recession or a credit cycle. I just don't see either of those things, in the cards for the next 6 to 12 months.
Thank you. That's very helpful. Any other questions? Oh, Steve, go ahead.
I'm just curious to know what you think about the run up in gold prices.
Yep. So I think that is more likely to be sustainable. I think I know I touched on this idea of U.S. exceptionalism. I think we are in the early stages of some countries and maybe some investors wanting to contain their overall US dollar exposure. So there is this idea, this phrase that gets tossed around of de-dollarization, where I think some global central banks would rather have a more balance in their holdings between US debt or US dollars in other forms and something else. And gold is often playing the role of a something else. I think in the early, 2 or 3 years ago, after Russia invaded Ukraine, you had central banks moving into gold because they were afraid of some type of US retaliation if something bad happened. I think more recently, it may just be people looking to diversify their holdings again away from treasuries. So we do actually we have a tactical view on gold. We're modestly positive on gold as well at the moment. So I think that may continue to have legs again in the face of some degree of concern about inflation.
Thank you very much. Appreciate your time. And we will continue on with our, let's see, Jeff, do we need to wait till 2 o'clock or can we?
So
training
let's do
session?
this. First of all, I want to thank Molly for arranging to having Adam available today. Appreciate always have our strategic relationship with one of our managers. So thanks to Wellington for making him available for us today. And then maybe I'll do a quick introduction to this topic and then turn it over and try to get you as close to 2 o'clock as you can for the start of that. So we're embarking on, and we've reported on this before, a significant effort in the next couple of months to do this assessment of our pension administration system. And that is an effort to see how well the system performs against our current requirements and what it can do for us in terms of enhancing our customer service. Because we do need to begin moving towards things like self-service and the ability for people to get information instead of having that to come to us to get everything. And part of the assessment that we're doing with the Siegel Group is to look at that level of functionality in our current system, in particular into the existing member portal function that we have. Because the system that we have today has a member portal function. We just don't have it turned on. But also part of this too, that will be just a total part of the assessment that will eventually bring to finance and risk, is what I've reported for, is that we're probably faced with potentially having to upgrade our current system to be able to take advantage of certain things. The upgrades we know from dealing with others that have the same system can be costly, but it may be the only way that we can get at providing some of the additional service features that we want to get. So that's also part of the assessment that's going to be going on. It's already started and is going to go on over the next couple of months, and then we'll report out on the result. So today we just wanted to try to take this opportunity to show you one of the key things that we would be looking at in terms of a service enhancement, which is a member portal. In other words, our members and retirees and beneficiaries being able to get into certain aspects of our benefit management system to either be able to view certain things of data or get access to certain types of information. And I'm not going to spoil it by going through everything, because that's what happens is then I do the presentation and they're like, why did you say 1099s, W-2s and all the rest of that when we're going to do it? So it is, so if you are going to ask me how many other CERLs have a portal, I would say by far the majority of them have. And so we need to move to that. There's a security aspect of this also too, because most of the places where people will talk to you about situations where they've had security breaches have come through their member portal. And it's not hacking into the portal. It's using somebody, as you heard in the prior presentations from our security people, trying to give you credentials so they can just get in, right? So we have to, it's not just a technology assessment, it's also an assessment of what security features do we need to have in play. So the SEAL group will also help us with that, but also so will Lineage Secure play a role in that. So there's a lot going on with this, and this is just an attempt for us to show you visually what are we talking about, what would people be able to access. So there it is. Not a surprise I can talk with.
All right, member portal discussion, a demonstration with Anya Blair. Thank you.
But just quick question before we start. Maybe I asked this question first. So the assessment we're doing with the vendor currently is focusing on this system.
Yes, we are not
okay,
doing, this is not a search.
Okay.
Okay, we are assessing this system, and we're not expecting to come out with a recommendation for a search, but part of doing the assessment is, does it fulfill our needs? And so we think it does, obviously, and but that's on the table if that was the case. That if it didn't, then that could be something that we recommend, but that's not what we're expecting. And that's not our goal of doing this. Our goal is not to present you a system replacement.
Jeff, what is this replacing? What do our members have access to now?
They don't have any access
They
to
don't have-
anything. No,
So
nothing.
there's no tool that
No.
none of our, so
No.
this is this
No.
would be a new experience for
Absolutely.
them.
Yes, yes.
Thank you.
And are we receiving feedback from the members
We do.
that
We do. Yeah.
they're disappointed that they're not able to access this information online versus just calling?
Yeah, in particular, I will say that those members, and to remember that, not remember, but somebody who comes from our system from a CalPERS agency is going to be a reciprocal member. In other words, they can get benefits in both systems. Okay, well, I can go to CalPERS, get online, fill out my retirement application. I never have to talk to a CalPERS person or fill out any piece of paperwork or anything. I get it all online and do it, right? And so we've had members who say, so I can do it online with CalPERS, but you guys still need all of this paper stuff filled out. So yeah, we get that feedback from people the same, like, once again, when it gets to the annual notifications we do, like 1099s to retirees, why can't I get it online? Why can't I get it myself? Why do you have to send it to me? So yeah, I think it's still a high touch customer service. Okay, so that's the one thing I do want to lead with, is that we are in a very high touch county. And that's not going to change immediately, but more people want to move away from high touch. And when I say high touch, they want to talk to us on the phone. They want to walk into the door. They want to have a face-to-face thing. But there are more people who would be more than happy to just have everything be electronic. So we're going to have both services, but so far we've just been one.
All right. Hello, everybody. Last
Hello.
presentation of the day. I'll make it short and sweet. I have Sydney Palaplata with me. She's the benefits supervisor. She's in the system every day, so she might jump in and provide some additional detail as we go through. As Jeff mentioned, this is just a presentation overview, big picture of what's available in our pension system. This is a portal in the software, so it's not a standalone product from them, meaning that a lot of functionality available to us will be available to the members. Jeff mentioned it's not available on the current version that we have, so we can just decide to implement it. If we did want to go forward with a member portal, we would have to upgrade the system, which is a separate discussion. So this is not a live demo because we don't have it available. This is just screenshots from the vendor. They did do a demo for us, so we've seen what it looks like in their test system. We also talked to some other systems who are in the process of implementing that. San Diego is going through the system upgrade, and then they're looking to implement the member portal. So we have somebody else we could talk to about their experience. So we'll talk about the functionality and then the benefits and the risks. The portal has functionality that is different for active members versus retired members because they have different needs. On the login screen, there is a dashboard available and we can customize. CPAS is very customizable for us. It's also customizable for the member portal. So we can pick and choose the look of it, the font, and the functionality. So what we make available to the members in general or in the first phase versus the second phase of implementation if we do decide to go with it. So there is some personal information that they can see. There is a snippet of their pension amount as of today, what they have accrued so far. On the bottom, there are documents available. This is one of the biggest requests that we get from the members is to provide them the statement that they either lost or they throw away. Provide a letter with the account balance. So this is somewhere they can go in and have those documents available to them. The system has the workflow built in, which is up here in the activity status. Again, it's something we can decide whether we want to go when we implement the system, the portal. And this is where the member can see what has happened with their account, whether they applied for retirement, and what the status of that request is. There is also a section for the seminars. Right now we have it available on the website where members can go in, look at the schedule, then they sign up for that. They can do that on the member portal. They can see what they have attended so far and what's coming up. We can also push out notifications at the top here, just like we do with news updates on the website. We can push it out here and the member can view those. We can link some articles here as well. And if we had videos available, we could make them available here as well. This is the retired member home screen, a little bit different from the active member, again, by the virtue of what's needed. Again, personal information. There is a health kind of tile here. This will be different for different members because we don't administer health benefits for all the employers, only county and some special districts. The retirement amount that they receive, and also at the bottom there is a documents section as well. Again, I'll go back here. The documents section is something right now that we will utilize, I think, heavily. Right now, we mail all the pay stubs for the retirees because we can provide them electronically. So this is where they could view the pay stubs. This is where we could post 1099s. Again, one of the most frequent questions when we mail those is, can I have a copy of my 10? Get it, I lost it, things like that. There are some buttons on the side here that are action items for the members. They can update the information, beneficiary, payment instructions. Again, this is something that we can decide to open up or not. At the top here, there are tabs available, and when the member clicks on the tab, it opens up additional options. So I'm going to show one of them for the personal information. On the left here, there are different options that the member can choose from. They can view their address history, update the address, update the beneficiary, view the communication. Again, this is something that we can open up or close down. We will also have to decide for the active members, for example, all the information comes from active payroll. So we don't necessarily want them updating it twice. So we'll have to make decisions on how we handle that.
And active payroll is the employer's payroll. Remember, all the data that we get comes from the employer and is from the employer's payroll process. They customize that payroll data and send it to us.
So once they update with the employer, it comes to us and automatically updates on our side. Yes.
Couple of quick questions on the active member. When it says the accrued pension, is this the difference what happened between the last statement and today? Is this like
It's
day to
current,
day?
like as of today,
As of,
for the earliest retirement date.
And I think that one of the things that we can also customize, and correct me if I'm wrong, is the labeling
Yes,
itself.
that's
I think
correct.
we wouldn't use something like the terminology that they're using there for that particular item. We would probably
Yeah.
say retirement benefit estimate as of
Of today.
today.
exactly, I want to
Right.
ask about
Yeah.
that. So the other question, as of today, is it electronically you're getting the payroll information from various?
Yes.
through
It's
this
going through
system?
PPAP.
So-
Mhm.
And somebody manually keys it into CPAS
No.
or is it?
No, no.
Okay.
We have an
Uploads.
It's all
automated-
automatic. Okay.
An automated feed that puts the data into the benefit.
Upload, and then we have our staff review that data before they post it.
Thank you.
So that's just a sample of an option to update beneficiary. Again, this is just coming out of their test system, so it's not going to look like that for our members, but that's how they could initiate the process of updating a beneficiary, for example. As you know, members can purchase service. This specific functionality would be useful for a member who already had the service purchase calculated and provided to them, and then they want to receive an updated quote. The reason for that is because right now we don't have data for the purchases, meaning if the member had some service prior to membership, we don't have the data in the system. It's the same with a medical leave. The employer doesn't provide the data to us because they don't pay contributions. Those are the hours they don't work, but they can purchase. If we do make that calculation for the member, they don't purchase it right away and they wait a year, let's say, and then they decide to proceed. This is the area that will give them opportunity to recalculate that amount rather than contacting us for recalculation and provide them the new quote. They can also view how many, if they decide to pay it off with a payroll deduction, they can view how many pay periods they have paid and how many are remaining, paid off if they want to. The member portal has functionality for the document uploads. Again, this is the area we would have to look at because currently we're in the process of implementing electronic signature process, which integrates with our document management software OnBase. That's where all the files reside. So we wouldn't want to do it in two places. While this has functionality to upload it and it has functionality for the workflow, we would have to decide which documents we would accept through there. And they do not integrate with any of the vendors and electronic signature processes. So. The system, we can open up the system to provide retirement estimates. Currently, we have a calculator on the website that's pretty simple. The member can go in, put their information, and receive a quick estimate. When they contact MCERO, we audit their account, review the data, and provide a more accurate estimate for the members. This will give them same functionality. I will preface that with explanation that the data is not always clean that comes from the employers. So right now we're investing resources and staff time to make sure that we educate the employers on what we expect for the data. CPAS has functionality to validate the data that's coming in and give us the report for the errors and warnings. And so we're working with the employers to make sure that they know what the data should look like and it's correct because ultimately it fits into the calculations for the members. And the more accurate the data is, the more accurate the estimate will be. And this is the result that the member could get. Right now on the website, it's only an unmodified option, the highest benefit that the member can receive. In the system, they could view the multiple options for the retirement and how those amounts differ. This is an estimator that some of the other systems have, like 457 plans where a person can enter additional earnings, additional savings that they have. And the system can project what those would look like in retirement. So they can play in the system and put their social security amounts or their savings and project out. As Jeff mentioned, some systems have ability to initiate a retirement application. This portal has that functionality as well. They can start that. The system is able to, again, to build a workflow for our staff to take that initial application and then move it forward and approve it. And the member is able to enter the payment instructions, tax instructions, upload documents. Right now, all of that is done by paper. So this is some additional functionality that's available in the system. I mentioned some of that. I think on-demand letters and statements are the biggest requests for the documents from us typically when members call and request, account balance. We can upload our own forms, and then the member can just generate the letter from the system with their information using that form that exists there. Any questions so far before we move on to discussion?
Every time I look like as an active member, that famous 2.5, this formula, which is like
The tier, yeah.
Yeah, best to say I still don't understand it. Is it gonna be automatically? I sign in.
Yes.
So it's gonna be showing the.
That's one of the questions we get is what tier I'm in.
Okay.
Yeah.
Well, and your percentage multiplier too. When today, while we don't have something out there that is a chart where you can go and see in my tier at my current age, what percent multiplier am I at right now? If you do run an estimate on our website, the result shows you for the date you enter or for your years of service and your age, what percent multiplier is being used in that calculation. So that could certainly be something we would consider as a data point. It's all going to be plugged into the background of the member portal. So if it would be useful for people to have that.
Oh, we could
percentage.
plug it into the in the links
Yeah.
available, right? Like the
Right.
chart.
I think it should also be part of the main member information account. This is your tier. This is your start. So like the main
Snapshot.
the main item.
Yeah.
Question, to what extent do you verify for accuracy?
The active, which part?
The member inputs as well as the documents that come in? Or is that just based on faith and trust?
No. Full audit of the account. So whenever somebody contacts us for an estimate, SID's team does full audit of the account, meaning they look at all the data that came in, they look at the documents that we have in on-base, they review the member file in totality and make sure that all the data that we have correct and there aren't any documents that require action.
Sid, you confirm that with the sending employer? if you will?
Absolutely. Absolutely. We request pay stubs, everything.
If there are
Yes.
questions.
These illustrations are on a full screen, a laptop or PC. But a lot of people don't use those. They do it on their cell phone. And the screen is much smaller, harder to read, and so on and so forth. So I'm just wondering, when you look at this and the presentation to the user, have you is recommended that they don't use their cell phone, and do most people just use their cell phone?
Is there an
Or
app?
or is there a different
There
user
isn't.
interface there?
Yeah, there isn't an app. I think it's compatible to view on the cell phone. I don't know how much action they'll be able to do on the cell phone. Right? They might be able to view information, but as far as taking an action, not sure cell phone would be helpful.
I'm sure this will be in the assessment too.
Yeah, to see what it looks like.
So just operate as through the browser that phone has, and just as if you were browsing on your desktop or laptop or iPad.
So it's CPAC, right? That's the name of the company that
Yeah.
does this. Are they providing the back end support for the failure of people remembering their passwords?
That's one of the
No,
items,
no.
that's one of the items we're gonna talk
No,
about.
So, so here's the thing. So I'm just gonna answer all of these questions you're asking. The administration of this is to be deemed.
Well, they don't
But-
provide support for
But
the
what,
members.
what we can tell you is, we will have to have those procedures. Right. People are gonna call us. We will have to figure out how we're gonna validate if somebody puts information in that the information that they did was correct. The biggest thing about throwing these things open is nothing about data accessibility. It will be about data correction. We will have to be set to answer all the questions from people that said, I logged into my account and this isn't right. And that's gonna be the first 6 months of this. Okay, so all of that's gotta be set up. This is just showing you the nice end of it after about 2 years.
Yeah.
This is the dream state.
Okay, so in other words, somebody's gonna have to be able to access us. If they gotta log on, we'll then have to have procedures for how to validate that it's a real person, not somebody trying to get into somebody's account.
Yeah, that's.
That's all gonna be on our side. That's what I said earlier. Linear Secure will help us with how all of that's gonna work.
So looking at that 2 years down the road model, is this going to change your internal workflow and releasing staff to now do other things? And are you thinking about and planning for this person is no longer doing these manual entries or responding to these phone calls? They're now gonna do X, Y, and Z down the road to improve whatever.
Yeah, it's
I think
trade-off.
Yeah,
because-
that's
be-
exactly.
Because we will gain some efficiency with not having to deal with phone calls. I want my 1090 statement right log in, and we still have some of those. But then we will have to have somebody on staff because we want to have a person available to help with any questions, to help with any issues. So it will be, we'll gain some here, and I think as we progress and as people get more comfortable using the portal down the line, it will be less and less hand-holding. But I imagine that at the beginning will be a lot more investment in time.
But it's just repurposing resources to do something different.
Mhm.
So instead of somebody, once again, like Anya said, dealing with estimates, phone calls, walk-ins, that person is gonna be supporting the portal, whether it's access, whether it's data cleanup, whatever that is. So we just redeploy resources in a different direction.
Yeah, but a lot of active members asking for something. They want to.
Yeah,
And
because
getting rid of the mail too would be huge in preventing fraud.
The pay stubs.
So much mail is getting stolen nowadays, and if you're putting 1099s in the mail, everybody knows they're coming, so that would be good. And plus, people can they get it 24/7
Yes, that's.
whenever they want it.
yeah.
Sounds like a good, and people expect it. I mean, I think we all have portals for just for everything we do in life. So
Mhm.
it's not like it's a novelty.
is it currently the KeyPass residing in our own infrastructure here, or is the basement?
It's on the cloud
It's-
and it's secure. So for our stuff, we can only access it from here. So it's a secure VPN tunnel. Employer portal where they have limited functionality to upload payrolls. They have access to that specific functionality. And we're implementing the MFA functionality for that. So this will be to the point of security, something we have to look at, how we implement it, right? Who is responsible for the security, how it's going to be open up to the public. So we talked a little bit about some of these points. Again, we'll have to consider the security. Linear Secure will help with that. We'll have to involve them in the process. Who's going to help support the issues with access? Who's going to help support just questions on functionality? And how much of staff time will be devoted to that? As I mentioned earlier, there is a lot of functionality available. We'll have to decide which one we implement, which one goes first, second, not at all, where are the risks and how we mitigate those. If we implement workflow, what do we review? What do we just let the member do on their own? And the imaging and the document storage. As you know, we have 9 employers. It will be different, like I showed on the health premiums and subsidies part, some of that information. We have that's available and we can make it available to the member. Some of it we don't administer, so we can't make it available there. The tiers can make for example, the retirement estimate more complex, but typically the system handles it pretty well. But again, it's something that we'll have to consider. That's all I got. Any other questions?
Are you considering an opt-in to this, or are you gonna implement it? Do you think you're gonna implement everybody?
TBD.
Well, I think everybody will have to have,
Wait,
right?
So I think you can imagine for anybody that's rolled out any kind of portal like this, they phased it in very slowly. So it started with access to one thing. You can look at your general skill. What tier are you in? What's your account balance? So it's static data. And they saw what the experience was with accessing static data. That went well. They rolled out other things. I'm not saying that's what we'll do, because Anya and her team will decide that along with the people that we engage to help us out. But we're not going to just throw it wide open. It'll be a staggered
Right. But it
implementation.
will be available to everybody.
Yeah,
right?
but
All the
eventually it
members.
will be available to all members. That's the goal. Whether we do that all at
Like,
once
let's hope.
with a limited scope, or do it with one employer with a larger scope, we'll work that out.
I'll make just an observation here. We are a county here where most people work close by, if you will. It's not like CalPERS where people are all over the state, and they don't have offices all over the state. So it's a whole different situation for them. Or even you take San Diego County, again, people are all over the county.
Mhm.
We have a kind of, at least as far as workplace is concerned, a concentrated county. So it's maybe a little bit easier for people here to do things in person than and then for others. And so for others, it may be more important to implement this from the point of view of customer service than it is for us. Not that we shouldn't do that,
Mhm.
but it's not as again, this is a point for discussion, is critical for us. And I certainly hope that it doesn't open up any risks, because that would be not good.
Mhm.
I think I said this earlier. We're not replacing the current service model. We're adding to the current service model. I agree with you, Trustee Silverstein, is that we will always have people that want to be here because of proximity to the association, and just that's the way they feel. So we're always going to offer that model, but we need to begin to offer other models, because there's other things that I will come to Anya about and say, I learned about this new AI plugin tool that does something in your phone system and stuff, and I would love to investigate that. Just who does she break free to work on, or who do I break free? So we have to figure out a way to free up some resources to be able to think creatively about services. And that's what we hope this will do for us, is begin to have those people who do want us to do self-service be something where we're not having to use manual power to get that.
Anya, when do you think this is going to actually roll out? Do you have a time frame?
I think it will depend. I think we have to get through evaluation first and see what comes out of that and prioritize it. We're going to look at the member portal as part of that process. And I think after that, there'll be discussion about the system upgrade, because there is a cost. So we can't implement it unless we upgrade the system.
Is it this year? Next year?
Not this year.
Not this year, okay.
Not this year.
I mean,
So we're gonna go
calendar year?
to August
Calendar
with the evaluation.
We're not giving you a time frame, so you can ask, but I'm not going to give you a time frame, because for one, there's a price tag sticker shock that you're going to look at us and
Yep.
say, really?
Yep.
And you're going to say, so you want us to authorize you to pay that? Couldn't you go get another system for that? So we got to get through that discussion, because I know how much you like to talk about things that we want to spend money on. So that's got to happen before we get anywhere. And we have to know for certain this is the system that we want to do this with. Because if we're convinced that this is the right system, then we'll come to you and we'll say, yes, we do believe this expenditure is worthy of this because it will add these things.
Mhm.
But if it's not, we got a whole different discussion with you because amongst my peers that have done software replacement projects, there's not a good story that I ever hear. And I know that because there is no off pension gold, no matter what somebody tells you about Vitech or pension gold or any of them, all of them have to be customized. And remember, we have 48 benefit tiers, so ours has to be even more customized. So it's a significant effort if we decide that we need to do a search for a different platform. So we got to get through that. That's a lot. That's a lot. Once we're through that, once we're through that discussion, then I think we'll be able to say we could do this. They could probably do it pretty quickly, but we need to think through this because once again, I've experienced this multiple times. If you're not ready for the support feature of this, it can crush your organization. And so because we're high touch, we can't afford to say we're busy working on computer things today. That won't work. So we've got to
Dedicated resource.
Right. When we throw the switch on this, we have got to be ready to support it full.
And I know the system upgrade, I was told would be about 4 months.
Okay.
And then the member portal.
I got a question about, so the system upgrade, having been through them many times, do you expect to see more functionality just in the base program that you have now? Not a lot of improvements, just simply newer software version?
Yes.
More
just new-
compatibility?
yeah. Prettier. It's UX UI.
Okay.
The user interface.
But the biggest issue about that is everything that works today has got to work on the upgrade. It's
Yes.
like installing a new system.
Right.
So we will
Testing.
have to go through
A lot of beta tests.
a dedicated testing process to make sure that the upgrade didn't break anything that previously worked just fine.
Oh, it
Right.
will.
That's, yeah.
So it-
Which
That's
is,
the time commitment to.
yeah, which is why you should never give us a date.
Does that mean that we are far away between what we have today and the latest?
As
Like
far as-
many versions and
No, it's not, they don't even call it a version. They just call it like user interface. Base.
Thank you very much. That was terrific. Any other items? Any follow-up items? Closing? I'm ready.